Matchup, unfortunately, at the moment is to the downside.
It is indeed. We're seeing the FTSE 100 opening down at 0.2%. You can imagine that's going to go further. Basic resources, of course, part of the mix. You have seen oil prices easing up to add some numbers to that. Still below $70 a barrel, though, as we look across to OPEC Plus and that meeting. But the reversal that we saw in the S&P 500 yesterday was marked. The biggest reversal we've seen since about April of 2020. Investors still digesting the remarks from Jay Powell, just reiterating the case for a faster taper come December. And then we heard from Mester as well, speaking to Bloomberg, suggesting that the base case now is for 2 hikes come 2022. The market's pricing in 2, possibly 3. We'll see how that unfolds. Falls of almost 1% on the FTSE 100. The CAC Cajon is lower by more than that. The Spanish IBEX also lower by 1.3%. Let's move it on to the cross assets, see how things are playing out across the oil space, but also the futures stateside as well, pointing to gains of 0.6%. This has been reflected in what we're seeing in the US 10-year yield as well, edging up 4 basis points at 1.44. The Turkish lira, of course, remains in focus after the decision, the surprise decision by Erdogan to replace the finance minister of that country, and the Turkish lira hitting a new low. We'll keep across that currency, the worst performing currency so far year to date. Brent again in focus, gains of almost 2%, just eking up above $70 a barrel as we look ahead to OPEC Plus and whether or not it holds back on additional production. Danny?
Tom, I'm looking at IMAP at the moment, so this is your view of what the different sectors are doing. It is a textbook move to safety in this equity market at the moment. Red across the board, as you were mentioning, it was that reversal in the US that Europe is now having to reverse as well. The only solid chunk of gains you are seeing is in healthcare at the moment. Again, this is one of those assets that if you're worried about what's happening, perhaps you flock to healthcare, perhaps a little bit of consumer goods as well, so we see a streak of green there as well. But elsewhere, even as you were pointing out, that we're seeing oil gain, we're still not seeing energy outperform. Materials are still weaker as well. So investors taking this opportunity to really sell across the board. And I should say we're seeing tech also in the red as well. Of course, we had that Bloomberg scoop about Apple and demand weakness as well, Tom.
Yeah, that was really interesting from, of course, Apple's perspective, given that they've already had cut production by about 10 million units for the iPhone 13. That was on supply chain constraints. Now, as you were saying, according to that Bloomberg scoop, the demand picture for the iPhone 13 is weakening as well. That message to suppliers around that impact. And we'll see how the read across is for suppliers to Apple. ST Micro is one of them. You can see losses of 2.5%. They provide some power management chips to Apple. You can look at ASML as well in terms of what this means broadly across the chip space. Darktrace, this company down 1.8%. It's been bumped off the FTSE 100 despite and after this record run-up that it saw after the IPO in April, the run-up up until September, but there was a drop of about 50%. That is now off the FTSE 100. We'll see how the tracking, the ETFs and the funds and that realignment, if that adds additional pressure to this stock. The cybersecurity firm. Repsol, we are seeing reports. They're looking at spinning off part of their renewable energy business, valued currently at about $4 billion. Losses of 0.9% for the Spanish oil and gas producer. Okay, let's get the Bloomberg Business Flash now with Angel Feliciano. Angel.
Thanks, Tom. Bloomberg understands Apple has told component suppliers that demand for the iPhone 13 lineup has weakened amid the global supply crunch. The firm had already cut its production goal for this year by as many as 10 million units, down from a target of 90 million. Apple is still on track for a record holiday season, despite the signs that some consumers may have given up trying to get the hard-to-find handset. Hermès is set to join one of Europe's main equity benchmarks, further bolstering the French luxury company's visibility among investors. The maker of Birkin handbags is to replace Universal Music in the Euro Stoxx 650, effective from December 20th. Hermès has been benefiting from a boom in luxury demand that accelerated during the pandemic. UniCredit is planning around 3,000 more job cuts as its CEO, Andrea Orcel, focuses on profitable businesses after an era of restructuring. Sources tell us that many of the cuts will come from the Italian lender's corporate center to reduce bureaucracy. Orcel is also set to boost the bank's current dividend policy and focus on more lucrative products. And that's your Bloomberg Business Flash. Danny.
Angel Feliciano in London there. Thank you so much. Now, the Omicron variant is continuing to spread globally with new infections found in the U.S., Norway, Ireland, and South Korea. Worries over that and, of course, hawkish comments coming from the Fed set the S&P 500 to its worst two-day loss in 14 months. That's feeding into European markets this morning, which are sharply lower so far at the open. Well, let's dig into some of those key market drivers. We're joined now by Ven Ram from our Markets Live team. Ven, it does seem surprising in some respect that a headline about a new Omicron case in the U.S. was able to do this damage, considering it shouldn't really be that surprising that a case exists in the U.S.
Absolutely. I mean, it was no surprise that it would reach the U.S. shores, but I think it was the markets were just waiting for a trigger, and that headline provided the trigger for the markets. At the end of the day, you've got to look at valuations on stocks. U.S. stocks are extremely expensive. Whether you take the S&P 500 or NASDAQ, we are talking about upwards of 20, upwards of 25, depending on the index you pick. And those are not sustainable valuations in the long term. And if you have a Fed that is expressing its intent to go faster on taper and start raising rates, perhaps twice next year, then there's got to be a higher discount rate applied on stocks. And that will mean that stocks will have to feel the pull of gravity, i.e. they have to head down lower. And that's what we saw yesterday. It's a taste of things to come, I would say.
Venera, a taste of things to come. So we're just at the early stages then of a broader sell-off, a more prolonged sell-off. Is that where you stand at this point?
Yes, absolutely, Tom. I do think that stocks have a definite downside from here, depending on how fast the Fed actually starts raising rates. If 2-year yields and 10-year yields start rising, there's no way that stocks can stay at these lofty levels. So we are talking about a significant correction. And I don't mean the correction in the sense of the standard 20% decline, but it is going to be, that would signify a bear market. But there is some correction that you would expect from stocks in the coming year.
Okay, Ven, I have another head scratcher for you then. How do we explain the bid for the euro in a post-Omicron world when otherwise we've seen bids usually towards haven currencies?
Absolutely, Danny. The number of people that have been messaging me about the euro is amazing. And you know what is going on is slightly complicated. In the way, and I've written about it on the terminal this morning, the way I'm looking at it is if you're talking about a massive global risk off, i.e., this Omicron proves to be a big driver for the economy, holds down growth, and the Fed is not going to go faster on taper and start raising rates, then the euro will find a bid. But if the Omicron variant is just going to lurk in the background, growth is going to continue, the Fed and other central banks are going to tighten, then the dollar has upside rather than the euro. And that's the way I'm looking at it.
Okay, Venram, that is a currency that is well bid, and you've explained why that is. One currency that certainly is not, of course, is the Turkish lira. We had the finance minister stepping down, being pushed aside, however you want to characterize it. Of course, hitting another low, another record low for the Turkish lira. Where do we stand on the outlook for this currency now?
Absolutely, Tom. I mean, in the sense of, in the case of the lira, the policymakers yesterday took on the markets and they are saying that, look, we are not going to go down the path that we did in 2018 when there were similar ructions in the market. At that point, you will remember that they raised rates from 8% to 24% in the span of just a couple of months. This time around, they are saying that, look, we are going to intervene and take on the speculators head on. But is that a great strategy? I don't know, because if you look at their gross total reserves, it's about 128 billion and change. But if you look at the net reserves, it's pretty much negative. So what is the size of the war chest that they have? It doesn't look very big. And also they are kind of saying, look, we are going to treat the symptoms. If you've got a fever, you don't treat the symptom, you treat the underlying bug and the fever will take care of itself. And what is the bug here? The bug here is deeply negative real rates. And that is, even in a normal environment, that is not sustainable. And in an environment where the Fed is going to go aggressive on tightening, that's not a good recipe at all. And that's what they're persisting with. And we saw them firing the finance minister last night. So it looks like they are taking on the market. How successful they will be remains to be seen.
Yeah, the previous finance minister lasting about 12 months. We'll see how long the new one lasts as well. Betting on growth still, Erdogan. Okay, Bloomberg M Live's Ven Ram, thank you very much indeed. Coming up, Omicron spreads to America. But GSK adds to the chorus of companies and institutions saying that existing medicines will be able to treat the new variant. Is the narrative then starting to shift? We will discuss that next. This is Bloomberg.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap between people that were worried about climate and people that were taking action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. We're about 13 minutes into your European equity trading day. So far, shaping up to be a negative day, really reflecting a lot of the losses we saw in the U.S., which of course happened when the European markets were closed. So we're seeing losses of more than 1% for all of these indices. The FTSE 100 faring a little bit better, but we are looking at an overall headline index drop of 1.3%. Biggest drop today is in the technology sector. Now, GlaxoSmithKline says in early testing, its COVID-19 antibody treatment looks to be effective against the new Omicron variant.
Yeah, Glaxo's comments coming amid uncertainty, of course, about whether Omicron will be able to evade existing vaccines. Its many mutations, particularly on the spike protein that is the target of most treatments, has sparked concern and spooked financial markets. Joining us then to discuss is Bloomberg's Tim Lowe. Tim, are the signs now pointing to a picture where Omicron is actually less severe than we had feared, certainly feared last Friday?
Yes, with a caveat of we're still hopeful. I think last week, a lot of people's initial reaction was, oh boy, are we heading back to square one with this pandemic? We have to start all over. And earlier this week, Moderna came out and caused some anxiety, talking about its current shot may have a significant loss of efficacy. A couple days later, today, I think we're seeing more positive signs around the world. It's still too early to say definitively. We're still waiting, and it will take another week or two for a lot of the big data points to be clear on just how good our current vaccines are against Omicron. And but we're seeing some positive, reading the tea leaves, some positive signs. This news this morning from Glaxo pertains to a monoclonal antibody therapy, and it's one of the first real out of the lab affirmations that one of our tools is not losing efficacy at all, and so that's a very good sign. And one of the reasons for that is this therapy targets a part of the virus that scientists did not think would evolve. And in fact, it was present on the SARS virus 20 years ago. So smart thinking.
Okay, Tim Lowe from Bloomberg, of course, piecing together what we do know, what we don't know about the efficacy of these treatments and vaccines when it comes to warding off Omicron. Thank you very much indeed. Joining us now is Florence Bajot, CIO at Lixor Asset Management, to walk us through the market reaction to what we are hearing, not just about this variant, but of course the shift in stance from the Federal Reserve and Jay Powell, who reiterated again what he thinks needs to be a faster taper, possibly come December. Thank you for joining us this morning, Florence. Let's start then with the variant. What is your level of concern, given what we do know and what we don't know at this point? And are you adjusting your portfolio around what you're hearing on this?
I was listening to Tim's answer, when you asked him the question, where do we stand in terms of knowledge for the Omicron variant? And he was very hesitant. And actually, I agree with him. It's very difficult at the current stage to have a clear view because we just don't have enough information. So that's for one. What is gradually coming out is that maybe treatments could be working, that maybe vaccines could be effective, especially on difficult cases, and obviously that will be some relief. What we have been seeing for now, I think, is really a price discovery in markets when they are faced with very high uncertainty. And market reaction has been very strong, very negative, because this uncertainty is very high, and because if Omicron is indeed very contagious and lethal, then the whole growth story for next year could be endangered. What I find interesting is that when you compare the market reaction for this variant to what happened when we had the other waves or even the Delta variant coming out, is that in the past, reopening themes suffered a lot, but stay at home and tech fared well. And what we saw yesterday, with NASDAQ down nearly 2%, is that this is really a broad-based sell-off. And this is why I think it looks a little bit like panic. And if we do start to have better news, we tend to think this looks more like an entry point.
Well, Florence, on that point, not only is tech experiencing this broad sell-off with everything, but it now also has its own idiosyncratic issue of Apple warning its suppliers on demand as well. Is there any safety at this point to be found in tech, as you say, if that was the playbook last time around, or is that now finished?
Well, I think it's a difficult question because we saw that tech, as you were saying, from a macro perspective, did not benefit from the lower rates on the long end, which we saw coming down in recent days because the curve flattened significantly. And in addition, we have these news coming out about demand being lower at the current stage, which in fact could worsen during the coming weeks because all the news flow linked to COVID, Omicron, and even the Delta variant, which in fact in Europe Europe is the real issue today, could weigh on consumer confidence and demand. So in that context, if this negative news flow is maintained, obviously, I think all stocks are going to suffer. But if we get better news, which I think could be the case, that's in fact our central scenario, yes, then I think tech could recover.
Okay, and we're currently seeing yields on the US 10-year at like 144, so comfortably below that 150 level, but yields have edged up in today's session by about 4 basis points. We heard, of course, from Federal Reserve Bank of Cleveland President Loretta Mester, and she told Bloomberg that the central bank could move faster next year if necessary. Take a listen.
As strong as it is in many dimensions, I do think that, you know, we have to be in a position that if we need to raise rates, you know, a couple of times next year, we're able to do that. So again, you know, quickening the tapering gives us that optionality.
Florence, you've been very nuanced on your views on where Omicron leaves us and the changes around central bank policy. Just as we look ahead to 2022, do we have to consider the risks around stagflation if indeed you get a slowdown in growth as a result of this virus, but inflation, as Mester was saying, as Jay Powell was saying, remains persistent? Is that a concern that we should be considering now? And is 2 hikes part of your core forecast for next year?
No, it's clearly one of the risk scenarios. And I think what's very interesting in this hawkish shift we saw from Fed officials is that it does come at a time where growth risks have increased. It's really different to what we saw previously, where every time there was a risk on growth, you know, we were able to count on dovish Fed comments. So Powell just dropped transitory. We just listened to Loretta Mester saying that, you know, increasing the pace of taper would give them more flexibility. The issue is that, in fact, all these comments come at a bad time because they coincide with the growth risks which are attached to Omicron. But in fact, I think it makes sense, you know, for Fed officials to have some additional flexibility in case inflation increases. And if you look at what's happening today on markets, the task of the Fed is really being complicated because on the one side, the virus is going to be negative for inflation. So that's going to be supportive because, you know, commodity prices are lower. But on the other hand, it could potentially increase all the supply bottleneck issues that we have seen and push up prices. It could also weigh on labor participation and push up wages in the US, which is a clear concern for the Fed. So the task of Fed officials, it's complicated. But overall, what we tend to think is that if inflation increases too much, that's a bigger risk than Omicron. And yes, we do call for 2 rate hikes next year.
All right, so sticking with that consensus that seems to be developing in the market right now of 2 rate hikes. Florence, really great to have you on the program with Tom and I this morning. That's Florence Barjou, CIO at Lixer Asset Management. Thanks so much. Now, coming up, first it was the global supply crunch. Now Apple faces a different kind of problem, slowing demand for the iPhone 13. We have that Bloomberg scoop for you next. This is Bloomberg.
from New York City.
In London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
you do not want to miss this
How
story.
are you thinking about those dynamics?
Welcome back to the Open. We are 24 minutes into the European trading day. You're seeing losses of 1% across the benchmark. The top sell-off in terms of the sectors, technology down 2.5%. Danny.
All right, Tom, let's get to a Bloomberg scoop. And part of the reason that technology is doing so poorly, Apple is suffering from the global supply crunch, but now it's confronting a different problem, and that's slowing demand. The company is said to have told its component suppliers that demand for the iPhone 13 lineup has weakened, signaling that some consumers have given up trying to get the hard-to-find device. Joining us now on the phone is our Bloomberg Quick Takes Alex Webb. Alex, how severe is this warning that Apple has given to its suppliers?
Well, it's coming out of sources from, reported by our colleagues, and it seems to be a bit of a blow, not catastrophic. They've already told suppliers that they expected not to be able to make, they expected to make 10% fewer iPhones than they expected simply because of the supply chain crunch. But that had initially been expected to carry on as demand into next year. Now they think that is probably not going to happen. Perhaps it's so hard to get phones, people have given up. It also gets to the point that the iPhone 13 wasn't a significant update to its predecessor. The update next year is expected to be far more substantial. So perhaps consumers are going, well, why buy a new iPhone when perhaps only 6 months later I'll be able to get an even better one? So that's why it's not perhaps such bad news for Apple, because ultimately the demand will resurface just at a later date.
Okay, many thanks to Bloomberg Quick Takes correspondent Alex Webb on that call by Apple to its suppliers that they're seeing weaker demand for the iPhone 13, but maybe going to get a pickup with the new model out next year. Okay, coming up, crude talk with oil prices in a bear market. OPEC Plus already had a lot to discuss. We're going to dig into the implications of that meeting next. This is Bloomberg.
Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels. There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with through fuel cells.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the Open. We're 30 minutes into your European cash equity trading day. Here are your top stories. Apple's holiday woes. After a global supply crunch, a Bloomberg scoop says the iPhone maker now faces a new problem, slowing demand. Europe is facing an unprecedented energy crunch. Energy ministers from across the EU meet today to discuss how to alleviate the pain. Plus, it's not just junior banking pay in focus. Over at Goldman Sachs, CEO David Solomon and his deputies have been looking for ways to juice up their own pay packets. We have all the details in today's Big Take. Tom, it's shaping up to be a negative day. It's not just Powell, it's not just Omicron, but it's also now Apple demand that these markets have to contend with.
That is an important shift, isn't it? It was all about the supply chains for Apple and others. Now they're saying demand is falling off for the iPhone 13. Alex Webb saying maybe that's partly down to people holding off, waiting for the new model come next year. But if it is more than that, then that's going to be concerning, not just for Apple and its suppliers, but everyone else within that space. In terms of what the markets are weighing up, yes, of course, Jay Powell reiterating that he sees the need for a faster taper. Loretta Mester telling us that 2 hikes next year are looking appropriate. Weighing all of that up, of course, what we're seeing around Omicron, where there seems to be a view that is crystallizing with all the caveats that maybe this variant is less dangerous than some had thought come Friday. The caveats, of course, being there's still a lot that we do not know. JP Morgan's Kalanovich saying this is an opportunity to buy the dip. Our own Mark Cudmore saying we are at the beginnings of a bear market. You're seeing losses of more than 1% across the benchmark and down the FTSE 100 down 0.8%. Oil is in play again, still below $70 a barrel as we look ahead to OPEC plus and whether or not they decide to curb their production output. In terms of what is red across the screen, the whole lot in terms of sectors. Bottom of the list, though, and we've been talking about this, is technology. Part of that is the Apple story. Yields are edging up. Maybe a factor there, but you're seeing losses of 2.5% across the technology space. Travel and leisure lower as well, still weighing up these restrictions when it comes to travel as, of course, governments around the world try and get to grips with this new variant. Danny.
Well, Tom, I have another risk to throw into the mix as well, and that's Europe, which continues to face an unprecedented energy crunch. And today, energy ministers from across the bloc are meeting to discuss what to do to alleviate that pain. Now, Italy is the latest EU member state warning about potential blackouts. For more, we go to our European correspondent, Maria Tadeo, who's live in Brussels. Maria, how much of a concern are these rocketing bills?
Well, Danny, this is a huge concern on everyone's minds here. It's another week that we're debating about energy prices. This is the whole purpose of the meeting that is happening today in Brussels. And we know this has big social consequences. You know, this is something they worry about, the impact that this will have on consumers and households as we go into the winter. Everybody, of course, wants to heat up their homes, but you don't want that to cost you an arm. You know, this is a big social concern. The social fabric is a sentence that I hear all the time here in Brussels from ministers. And of course, we also know that it feeds into what is right now the biggest economic, but also maybe even political debate in Europe, which is inflation. Is this a one-off? Will it not be? And it will cool down in 2022. So the two stories are feeding into one. And Danny, once again, we're seeing going into the meeting, there is a document doing the rounds in Brussels. Again, the Spanish, the Italians, the Greeks, and also the French suggesting that there needs to be a common European response to this. That national measures are not going to be enough. This needs to be dealt at a European level. But we know that in the past, both some of the core European countries, but also the Nordics have said that they do not share this opinion, that this is every nation has to put forward its own plan.
So Maria talked about government intervention there, the divisions amongst member states around how far and how fast to go on that front. Is there any sign that prices are or will start to ease if or if not we get that kind of intervention?
and big divisions, by the way, within governments in Europe. Well, Tom, don't take my word for it. Look at the chart that we have for you. I feel like this is a chart that really tells you the story of 2021 when it comes to the energy markets. If you go year to date, the start of the year, you see that prices where they were trading, you compare it to where we are now, and this is triple-digit increases. And of course, this goes directly to the consumer. It's people that are going to pay for this. Now, in terms of where we're at, I want to focus the attention on Q4 because this is really where concerns begin to kick in. In September, we're back from the summer holidays, concerns about temperatures dropping. Again, we look at reserves. Russia keeps that very tight. We see prices really peaking, then they go down. Vladimir Putin suggesting that Gazprom will honor every contract, but we haven't really seen that reflected in the markets. Prices are once again jumping this week. We saw Spain yesterday, by the way, with a record energy pricing also kicking in, particularly for electricity. A lot of this has to do with, again, supply being very tight, but also the EU being cold feet about Russia. They don't really want to tap into the Nord Stream just yet. That certification's been delayed again by the German regulator.
Okay, our Europe correspondent Maria today breaking down what is happening in energy space and potential responses there across Europe as they look at these very high and sustained prices. Thank you. Okay, at the same time, of course, as the debate that is happening in Brussels, another argument over energy is taking place, and it's taking place virtually. OPEC and its allies are heading into a second day of talks on whether to pause their production increases as the resurgent pandemic throws the outlook for next year into disarray. Joining us to discuss is Bloomberg's Alaric Nightingale. Alaric, thank you for joining us on set. It's an important week for OPEC Plus. They're having to weigh up the release of reserves, but more importantly, arguably, what is happening with the pandemic and Omicron. What is our sense of how the debate is unfolding?
Well, as of yesterday afternoon, there was no sense that they might cut production, something that's kind of been floated as an idea. And it seems, the most likely outcome is a pause of production. But, as you rightly say, there are so many variables with the pandemic or with Omicron. So you just don't know. If we think about last year and the devastating effect that the virus had on demand, the ministers will certainly be very mindful of that. We had negative oil prices. So we just don't know where this is going. There are so many things that could happen. It could be quite mild. The word mild is being thrown around a lot. So if that goes, if there is no small impact on demand, then I guess they carry on. But they've just got to watch and look for every data point and evaluate everything.
This is a market that it doesn't matter whether you've been long or short. You probably have gotten burned at some point in the past year. Going forward then, is OPEC going to be a driver of these prices? Or is it all going to center around this demand and potential demand destruction if we get higher prices or a variant that throws a wrench into the cogs?
Well, I think OPEC is clearly going to stay relevant. OPEC Plus is going to stay relevant. It constitutes a huge part of global oil supply. And Saudi Arabia has shown that it can lead the other producers in making policy decisions. Last year, the rest said, okay, we're not going to cut production. So they said, okay, we'll pump at will, and they crashed the market. And then I think people thought, okay, we've got to comply, we've got to work together. They did work together, and they supported the market. So Saudi Arabia has that leadership potential if it wants to use it, and it surely will if it comes to it. So they will be able to. They've shown they can put a floor under the market. There's no reason to suppose that will suddenly change.
Alaric, thank you so much. A really fantastic preview ahead of today's decision. That's, of course, Bloomberg's Alaric Nightingale. Thanks again for joining us. Now, coming up, Turkey has another new finance minister. Will the new appointment push the lira even lower? We continue to see it hit new record low levels. We're going to be live in Istanbul next. This is Bloomberg.
Extra $1 trillion in spending not increase inflation.
by increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This Omicron thing's really new, but I'm pretty hardened about what I'm hearing just in the last few days. I'm always a positive person anyways. You have to be in this industry.
Airlines is the easy target for changing of signals to the public.
It's a bit early to say. You know, we had a very strong Thanksgiving in the US. It's a very important time.
Seeing reports just now that, you know, vaccines are working with Omicron and it's seems to be less virulent. So assuming that all holds true, I think things are just going to continue to improve.
I feel the vaccines have been fundamental in people's confidence to fly. You know, we've seen a very significant recovery in the US market. JetBlue flew as much capacity in Q3 this year as we did in 2019. Our airplanes were full.
It's not to the same level of downside that we've seen in previous times when there has been restrictions being introduced.
What I'm telling my team and telling the government in the UK is, as quickly as you introduce those measures, if things turn out that they are not as significant, take them back immediately as well.
Those are executives there from the airline industry speaking to Bloomberg TV about the impact of the new Omicron coronavirus variant on their business. Tom, I'm saying I love that comment from the Breeze CEO. You have to be positive to be in this industry. There's certainly a lot to not be positive about at the moment.
They've had to navigate quite the last 18 months, right? These new changes have been put in place as a result of Omicron. We're seeing now people are booking very last minute. I am very risk averse when it comes to travel. I've booked a short break, but only to the Cotswolds next week. A shout out to our makeup artist, Lauren. She said to me, she's got a trip to Dubai over Christmas. She said, come hell or high water, I will be on that plane. So there is that pent up demand.
Yeah, I'm all about that attitude. I mean, last year I booked a trip to Asia for this year, which obviously didn't play out, but it's really difficult for the airline industry because if people aren't like Lauren or me and they're waiting until last minute, it's very difficult for them to gauge demand.
We do need tips though from Danny, who has been jet setting quite significantly given all these restrictions within the context of what is happening. Danny. Okay, let's get the Bloomberg First Word News now with Angel Feliciano. Angel.
Thanks, Tom. Fed Chair Jay Powell has said for the second time in 2 days that officials should consider speeding up withdrawal of policy support. He told the House Financial Services Committee that inflation has become more persistent and policy will continue to adapt. Speaking exclusively to Bloomberg, Cleveland Fed President Loretta Mester told us she supports that view.
Going into the September meeting, I thought there was a strong case for tapering at a faster pace than what we had actually announced. And since that time, the data have come in supportive of that case. So I'm very open to considering a faster pace of tapering.
South Africa's daily COVID cases have almost doubled in a day to more than 8,000 as the Omicron variant takes hold. An earlier government report said almost 3/4 of samples sequenced in November were of the new mutation, displacing Delta as the dominant variant. Australia's chief medical officer, meanwhile, says there's no indication that Omicron is deadlier than other COVID strains. Paul Kelly says of the 300 cases reported around the world, all have been very mild or have shown no symptoms at all. Conservatives in the U.S. Supreme Court have suggested they're poised to roll back abortion rights and uphold Mississippi's 15-week ban. In an argument that lasted almost 2 hours, all 6 Republican-appointed justices indicated they would let states start banning abortion far earlier than precedent now allows. Under a 1992 ruling, states can't impose significant obstacles before fetal viability, which the court suggested was at around 23 or 24 weeks. And the Women's Tennis Association is suspending all tournaments in China, including Hong Kong, effective immediately. WTA chairman and CEO Steve Simon says he has serious doubts that star player Peng Shuai is free, safe, and not subject to coercion and intimidation. Peng's welfare has been in question since she accused a former Chinese vice premier of sexual assault. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Angel, thank you so much. Angel Feliciano here in London as well. Now, there's yet another change at the top of Turkey's finance ministry today. President Erdogan has announced that Nureddin Nebati as the new finance minister, replacing Lutfi Elvan after a little more than 12 months on the job. The move has weakened the lira back towards a new record low. Well, Bloomberg's Simin Demikan joins us now from Istanbul. Simin, what's the reason behind this latest move?
Turkey's former Finance and Treasury Minister Lutfi Elvan has been replaced, as you said. This after weeks of speculation that he would be stepping down. This comes as President Erdogan pushes for aggressive interest rate cuts despite high inflation, and this undermining the lira. The new finance minister is Nureddin Nebati. Now, he used to be the deputy finance minister, and he has close ties with both President Erdogan and President Erdogan's son-in-law, Berat Albayrak, who used to be the former finance and treasury minister before Lutfi Elvan.
Simin, the lira, of course, trading near record lows, the central bank being forced to continue, it seems, under pressure from Erdogan to cut rates, despite the fact that you're seeing inflation at, 19, close to 20%. How does this play out, do you think, for the FX markets going forward? What are traders saying?
Well, that's the million-dollar question. Where does the lira go from here? Of course, over the past month, it's lost 30% of its value, hitting record low after record low against the dollar. Now, yesterday, the Turkish Central Bank actually intervened officially in the FX markets by flooding the market with dollars in order to try and halt the lira's slide. This had muted impact. We're hearing that they spent around $1 billion US. This shows that they're actually extremely concerned about the lira's slide. Now, the central bank can also be left in an awkward situation when it meets for its next rate meeting next week. Earlier, Sharp Carve Jeweler had actually said that he would assess stopping rate cuts as early as this month. However, just a few days ago, President Erdogan revealed that rate cuts will continue until the elections, which are scheduled for 2023.
Okay, so possibly then you would imagine further pressure on the Turkish lira. Bloomberg, Simin Demikan in Istanbul. Thank you very much indeed. Coming up after junior banker pay, it's now executive remuneration that is in focus. We take a closer look in our big take next. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. We are 50 minutes into the European trading day. Losses across these European markets. The benchmark is lower by 1%. Futures in the US, though, pointing to gains of close to 0.6%. Let's take a look at some of the stories we are following today. At 10 a.m. UK time, we're going to get the latest euro area unemployment rate. At midday UK time, Brazil third quarter GDP data will be released amid rising concern about the near-term outlook for that country.
And then later this afternoon, we're also going to be expecting the numbers on initial U.S. jobless claims. And then finally, which we've been discussing today, OPEC and its allies hold a second day of meetings as the Omicron variant sparks price turmoil. Now, another focus for us, and really the recent focus on Wall Street, has been that of junior pay and, of course, helping to retain young talent. But at Goldman Sachs, many of the bank's senior leaders have come to believe that they're not getting paid enough either. According to today's Bloomberg Big Take, CEO David Solomon and his deputies have been looking for ways to increase their own pay packets. For more on this, we're joined by Bloomberg's Tom Metcalf. Tom, of course, sympathy goes out to the senior bankers, but what sort of incentives are they trying to whip up here for top management?
Yeah, they're taking a very unusual tack. Basically, SPAC, the special purpose acquisition companies, effectively Goldman has one of them, and what some of the leadership is pushing for is for them to get what's known as a promote. So basically a cut of the profits that SPAC might make, which is very unusual. It's, normally you see salaries, stock options, so they're really looking to kind of juice their salaries in a number of different ways.
How is it likely to sit then with junior bankers who have seen their own increases in remuneration and other perks to try and keep them at the firm? Is this, ultimately, is it deserved?
Yeah, it's interesting, and that dynamic will be fascinating to follow, because I guess on one hand, maybe the junior bankers will look up and say, hey, our CEO is getting paid, north of $30 million, when I'm on 100,000, and, this is a very elevated world, right, where that's the concern. But, in fact, me and Danny were talking about it earlier, it may be that, it helps sort of retain junior bankers. They can look up at the top ranks and they go, oh, actually, I can get very, very well paid if I can stick this out. It's an open question.
Well, among other things we were talking about earlier, the idea of how shareholders might react to this, if they would be okay with the idea that their executives are now getting higher pay.
Yeah, so if you look at Goldman's share price, since Solomon took over, it's up about 80%, and the past 4 quarters have been, blowout for Goldman. They've got record revenue, record profit, so you can certainly see the case for, Solomon getting a pay rise. I think what's interesting here is clearly sort of the various ways they're trying to push for this, and it's sort of taken a slightly unusual approach and seem to be quite aggressive on it. And that will be interesting to manage with all shareholders, I suppose.
Tom, what is your sense of how concerned they are about political blowback?
I wouldn't say too much. I mean, I think they, in America, they can look at those results. Government takes a, step back. So I think they're, probably looking more at folk like in the hedge fund world and private equity going, hey, our sort of conversation is relatively meager and compared to the top tier pair. So this is well deserved.
Yeah, that was going to be my question to you. How exactly does it compare, if they do get this sort of extra added pay, to things like private equity and family offices of the sort?
Yeah, I mean, look, we're still talking in the millions territory, right? Whereas, some hedge fund managers will pull in hundreds of millions, perhaps even low billions in a year. And then right at the top of the tree, you've got the tech entrepreneurs. So someone like Elon Musk, his incentive package, tied to a definitely tied to performance, but that's in the billions. So depends who you're sort of benchmarking yourself against.
Okay, Tom Metcalf on the changes afoot for senior executives at Goldman Sachs as they try and ensure that they are rewarded better than they already have been amid the pandemic, but of course, stellar results as well. Tom Metcalf, thank you very much indeed. The big corporate story really for us, Danny, today, beyond Goldman Sachs and its pay structure, is what we're hearing from Apple and the message they put out to suppliers, most of them, of course, based in Asia, some also in Europe, that they are seeing weaker demand down for the crucial iPhone 13.
Yeah, I had a really fascinating conversation with SD Dweck from Flowbank earlier, who actually said, okay, for Apple, this is a bad thing, but macro-wise, maybe this is a very positive thing. We're starting to see some of the supply-demand imbalances start to balance out. If finally some of that good demand is starting to weaken, of course, at the moment, this is just an Apple story, so it depends if we see this for other companies as well.
Our very own Matt Miller has been talking about his desire to get hold of new Apple products. And in fact, he's been waiting for months. Now we're hearing that, that those waits have been shortened to, what, 2 weeks or so, just to your point about this demand-supply dynamics. And Alex Webb, again, from QuickTake, saying, look, this may be a case of just customers waiting until next year when the new model comes out, maybe with enhanced features as well.
Yeah, got to wait until the better camera and filters come through. Got to make sure you're...
4, 5, 6 cameras. How many do we need?
Exactly. I mean, all for the gram, right? And look, you can see there we're looking at the GRR screen as well, technology leading to the downside, dropping more than 2%. But Tom, otherwise, you're not going to really be able to find any sector that's outperforming. Everything in the red today, it's the Fed, it's of course Apple, and it's also the virus and the potential strength or non-strength of it.
Yeah, and again, just to reiterate, the likes of JP Morgan, Kalanovic coming out saying this is a buy the dip opportunity, again, as their analysis at JP Morgan is that this variant is going to be less dangerous than maybe some had assumed. And you've got to layer on top of that as well what is happening in terms of central banks. Loretta Mess saying 2 hikes by 2022, which is essentially being priced in to these markets. That is it then for the European market open. Surveillance early edition is up next. Much more analysis on these markets with the team there. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concerned for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
U.S. needs to get back on a sustainable fiscal path.
Anything that purchases in the first, quarter or maybe early in the second quarter, right now, I would support that.
Whether it's Omicron or Delta or any of the variants, we know that vaccines are likely to have some protection.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. The Omicron variant spreads. The U.S. reports its first case, and Anthony Fauci says it was a matter of time. Crude dilemma. OPEC Plus meets to discuss production increases. Omicron throws the demand outlook into disarray. And stay with Surveillance Early Edition this hour. We speak to the economic head at the European Investment Bank and to the co-chair of COVAX. Send in all of your questions at IB Plus TV Go. First, let's check in on the markets. It's shaping up to be another ugly day. We're looking at European equities falling 1%. This is really a game of catch up to what happened in the U.S. yesterday. In the U.S., you had Powell reiterating his hawkishness. You also had the first case of Omicron reported in the U.S. But when that happened, Europe was still closed. We ended the day higher yesterday, so this is starting to look a lot like the U.S. session. Now, the U.S. futures are moving higher by about 0.5%. But adding to that turmoil is what's happening in tech. Tech, the worst performing sector here in Europe, down more than 2.5%. Apple reportedly warning its suppliers about demand for the holiday season. We're also seeing some selling coming into the 30-year yield. We saw mostly buying yesterday, perhaps a little bit of bid for protection. Yesterday, our guest Rupert Harrison told us from BlackRock that he still likes government bonds as a source of protection. And finally, the lira. It's another new head over there at the central bank. This continued turmoil in Turkey means the lira falling towards another record low. It's lower by 1.3% versus the dollar. Let's go ahead and also get your look at what's happening in Europe. We looked at the sectors, but it's also mostly red for European countries as well. The only ones that are declining more than 1%, you have the DAX, you have Italy, you have Spain as well. A little bit of outperformance when it comes to UK stocks and the CAC are on. I should say outperformance, but they're still down about 0.9% and 0.7% as well when it comes to these UK equity indexes. And again, a lot of this has to do with Omicron, and Omicron has officially reached the U.S. The CDC has confirmed a case in California. Now, the patient was fully vaccinated, has mild symptoms that are improving, and is currently self-isolating, according to them. But top U.S. infectious disease doctor Anthony Fauci was hardly surprised by the development.
We knew that it was just a matter of time before the first case of Omicron would be detected in the United States.
Now, over at the Fed, Loretta Mester says she's open to faster tapering to win space for potential rate hikes. The Cleveland Fed president told Bloomberg exclusively that higher rates in 2022 may be needed.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, we have to be in a position that if we need to raise rates, a couple of times next year, we're able to do that. So again, quickening the tapering gives us that optionality.
We're joined now by George Saravelos, Global Head of FX Research at Deutsche Bank, and Van Ram from our Markets Live team. George, I want to start with you. We heard from Loretta Mester there, seeming to coalesce this now moving consensus of 2 rate hikes. Is that your consensus over at Deutsche Bank as well?
So we've also moved to looking for rate hikes from the Fed next year. And I think the key point is, if you look at, for example, Omicron, there's this idea in the market that somehow it's this big shock, this big change to the outlook. But we've had these variants throughout the year. And if you look at how the market's been behaving, yields peaked back in March when we were most optimistic on the vaccines. And ever since, we've been going through these waves. And the reality is, it's these waves that have caused weak labor supply in the US. They've caused excess goods demand, causing inflation. So I think, if anything, this Omicron debate is actually pushing the Fed even more in the same direction.
Oh, interesting. Well, let's work through some of the market action then that was a cause of that. And Ben, let me bring you into this as well. We saw this bid to longer dated paper yesterday. We saw an equity sell-off. Would you categorize it as logical market action?
Yes, absolutely, Danny. I think it is the taste of things to come, as we discussed earlier, because you've got a scenario where Loretta Mester said that, look, 2 rate hikes are possible in next year, and that will mean that 2-year yields are going to be uncorked higher based on correlations with what has happened in previous Fed hike cycles. And if the 2-year yield and the 10-year yield kind of rise, it is a law of gravity that will work on stocks to bring them down, because you will be using higher discount rates to value stocks. And stocks had a very good 2021, at least until the end of November, because all we got was taper, so there was not a significant change in the discount rate. But if you're going to change the discount rate next year, then that means that stocks will feel wobbly.
Well, to Ben's point, George, we've seen yields in the front end of the curve move higher and at the same time flattening, and in some parts of the curve even inverting. What do you make of that?
So I think it's impossible to understand what's going on in the economy and the markets this year without having a framework for long-term yields. Because the reality is, you've had massive inflation surprises, a lot of central bank hawkishness, and yields in the back end have not moved. And I think the answer to that is actually COVID. It's proven more persistent than we thought. It's causing excess saving. People are saving, they're buying equities, they're buying Bitcoin, they're also buying bonds, but you can see that in the data. But also trend growth is falling. The market's pricing low terminal rates. And you can see that, for example, in labor force participation. In the US, it's the lowest since 1976. So all these things in the background, they're helping front-end yields go up. We're pricing more inflation risk, but at the same time, the long end can't sell off. And I think that's really critical to understanding what's going on this year.
Well, another thing I'd like to try to understand, and I happen to know that Ben has been writing about this on the MLive blog, so I want to get his take first, and then, George, see if you agree. And that's the recent strength we've seen in the euro. Despite Omicron, Ben, for the most part, it has been benefiting some of the haven currencies. What's your explanation for it?
Well, the way I think about it, Danny, is that a massive risk-off, i.e. one that compels the Fed to go easy on rate hikes, that will be positive for the euro, because that will mean the global risk-off dominates, Omicron dominates, global growth stagnates. That will mean a bit for the euro relative to the dollar. But if the dominant narrative becomes the Fed rate hikes and tightening all over the world, in the rest of the G10 world, and Omicron just lurking in the background, Omicron and other variants just lurking in the background, tangentially impacting the economy without doing too much damage, in that scenario, I see that the US dollar will be bid, which is why you've seen this uneasy kind of seesaw going on between the dollar and the euro ever since news of Omicron broke last week.
Would you agree with that view from Ben?
So I think, in contrast to the bond market conundrum, so to speak, there's no conundrum in FX. If you look at the relationship between the dollar and yields, it's exactly as you'd expect. Very sensitive to the front end. You saw this euro squeeze over the last few days because the market took away pricing of Fed hikes. Now it's added them back in. So I think that short-term relationship is very, very robust. If the Fed is hiking more next year, then the dollar should be strengthening and vice versa.
So is it euro weakness from here on out then?
Well, I still think the risks are for more euro weakness. And one underappreciated story is how disappointing European flows have been this year. So if you go back to the start of the year, the expectations, including my own, where you would see these massive inflows into Europe, the reflation trade, they never materialized. And instead, you're seeing very big European outflows as Europeans are back to doing what they've been doing for the last few years, buying US equities and buying US bonds. So the European flow picture, irrespective of the Fed debate, is also quite negative.
Fair enough. And that does seem to be a consensus emerging. Ben, is this what you're hearing? And specifically on the dollar in terms of the greenback's direction?
Well, I do think that if the Fed continues to push on with its taper faster and starts raising rates, I do think that the dollar is upside. And I would see that, last year, this time, I called for the dollar, much stronger dollar at a time when no one was calling for a strong dollar. And that has played out exactly according to the script that MLive predicted. So we've had a pretty strong dollar, pretty strong run up in the dollar. And I expect that to continue, albeit I think that the gains will be kind of moderated next year. We won't see the kind of run up that we have seen this year. Maybe 2 to 3% is what we are looking at.
All right, Ven, thank you very much. That's Ven Ram from our Markets Live team. George Saylor-Velas from Deutsche Bank is also here with us. He's going to be sticking around as well. I also want to get us a quick pre-market check on Apple as well. Falling as much as 0.8% in the pre-market trade. Some other Apple news as well. We also have Apple partner Foxconn in talks to help Saudi Arabia build EVs, so perhaps that's a boost for them at a time when Apple, according to Bloomberg sources, is warning its suppliers about potential demand weakening into this holiday season for its iPhone 13. So we've seen a lot of read across to suppliers, and there you go, Apple falling more than 1.3% in the U.S. pre-market trading. Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we're going to be discussing vaccine access with the co-chair of COVAX, and we're also going to be speaking to European Investment Bank's head of the economic department, about the state of EU business investment. Any questions for them or George? Send in your questions on IB plus TV Go. And of course, we're going to continue to talk FX, and we're going to talk Turkey after it replaced its finance minister. This is Bloomberg.
When your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Turkey's central bank says it is able to intervene to reduce what it describes as excessive volatility. That comment comes after yet another change at the top of Turkey's finance ministry. President Erdogan has appointed Nuruddin Nebati as the new finance minister, replacing Lutfi Elvan after a little more than 12 months on the job. The move has weakened the lira back towards a record low. Joining us now is Bloomberg's Simin Demirkan from Istanbul. Simin, set the scene for us. What's the reason behind the move?
Well, over the past few weeks, there could have been disagreement over the new economic policy. Of course, President Erdogan has been pushing for aggressive rate cuts despite high inflation and also undervaluing the lira. We were hearing speculation for a few weeks that Lutfi Elvan could actually step down himself. Now, he's been replaced by Nuruddin Nabati. He was the former finance minister, and he has close ties with President Erdogan's son-in-law, Berat Albayrak. Of course, Albayrak himself was the finance and treasury minister back in 2018. He resigned himself late 2020. Nabati, over the past few weeks, has been voicing support for President Erdogan and his aggressive rate cuts.
Simin, thank you very much for staying on top of the story for us. That's Bloomberg's Simin Demirkan in Istanbul. And George Saravelos from Deutsche Bank is still with us. A lot of volatility in this market, obviously. Is the lira one that you'd want to play in right now, or are you staying on the sidelines?
So the first thing I look at when you see so much volatility in emerging markets is the net international investment position. That basically tells you a country's exposure versus the rest of the world. And is there a big FX risk there? Are there balance sheet risks? And if you look at Turkey, there isn't really a huge source of balance sheet risk. A lot of the negative net international investment position is foreign direct investment. Foreigners have bought into Turkish companies, into stocks. So there's no very big underlying systemic risk on the back of this FX depreciation. So the risk is it just keeps going, I think, until the market reaches a new equilibrium.
Let's talk about a risk in another emerging market, if we can call it that. China, we're seeing the yuan continue to strengthen, multi-year high versus the dollar, even though there's been concerns about economic growth in China. How do you account for the strength there?
So I think the answer is COVID. You have record surpluses versus the rest of the world. The rest of the world is not going into services. It's still reluctant to go to restaurants, to travel. So we're all buying more goods. And China is at the epicenter of global goods distribution. So the external accounts are extremely strong. But China is still pursuing the zero COVID strategy. So you're not seeing the outflows. You're not seeing China services, China tourism, for example. So the external accounts are very supportive, and that's why you're seeing this counterintuitive scenario where the currency stays very strong, even though the economy has been quite weak.
Does that mean kind of in a perverse way that the risk to the yuan is normalization and normalization of COVID and being able to get out and mobility being restored?
Absolutely, and that's why I was writing earlier this week on the back of this Omicron news that the risk is China still stays very cautious. It delays China reopening. It delays so-called normalization in everything, and that, ironically, allows for a stronger yuan.
Well, at the same time, other EM currencies trading near record lows. The JP Morgan index of EM is at its lowest since they started the benchmark in 2010. How much risk is there, considering the Fed is now starting to head towards this path of tightening at a time where emerging market currencies are already relatively weak?
So the single most important variable, I think, for emerging market currencies is relative growth. If you go back to 2010, 12, when you had this huge EM outperformance, EM growth was doing much better than DM. And now you're seeing the opposite. Emerging markets have lower vaccination rates. They have issues around fiscal policy. They have big issues. Some have big issues around inflation. That's why central banks are tightening so much. But all that means on a relative basis, EM growth underperforms. And I think the risk is you do continue to see EM currencies underperform as well.
This just reminds me of how far we are away from the world pre-COVID, when the story was synchronized global growth. What I'm hearing from you is we are nowhere close to that.
Absolutely. So I think a big part of the market hope, the market narrative in Q1 was that the vaccines would somehow save the world, would go back to the old normal. And I think what's happening is we're in a new normal where all of strange things are happening. US labor force participation is not picking up. People are still staying home. You have excess savings. You have this massive skew in favor of goods versus services. So it is very much a new world, which I think causes all these surprises in terms of market behavior. And it's very likely to persist.
Yeah. Unfortunately, we're out of time, and we didn't even get into commodity currencies, which, again, is another one of these strange things we have to contend with. George, it was really fantastic to have you on, have you in the studio, and catching up with you today. That's George Saravelos, Global Head of FX Research at Deutsche Bank. Thanks again for joining us. Now, coming up, speaking of oil, crude talk, the oil prices are in a bear market, and OPEC Plus already has a lot to discuss at today's meeting. But now there's a new variant to contend with. We're going to look forward to that decision next. This is Bloomberg.
when you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News now. Here's Leanne Gerrans. Good morning, Leanne.
Hey, Danny, and thank you. Conservatives in the U.S. Supreme Court have suggested they are opposed to roll back abortion rights and uphold Mississippi's 15-week ban. In an argument that lasted almost 2 hours, all 6 Republican-appointed justices indicated they would let states start banning abortion far earlier than president now allows. Under a 1992 ruling, states cannot impose significant obstacles before fetal viability, which the court suggests was at around 23 or 24 weeks. And the Women's Tennis Association is suspending all tournaments in China, including Hong Kong, with immediate effect. WTA chairman and CEO Steve Simons says he has serious doubts that the star player Peng Shuai is free, safe, and not subjected to coercion and intimidation. Peng's welfare has been in question since she accused a former Chinese vice premier of sexual assault. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Leanne Gerrans there. Now, OPEC and its allies are heading into a second day of talks on whether to pause their production increases. That's as the recent pandemic throws the outlook for next year into disarray. Joining us to discuss is Bloomberg's energy and commodities editor, Helen Robertson. Helen, good morning to you. Thanks so much for joining us. It does feel like not that long ago that we're talking about the possibility of $100 per barrel oil. It's so different now with this new variant threatening demand. How does that play in to OPEC's thinking today?
Good morning, Danny. Yes, you're absolutely right. I mean, how quickly things can change in oil and geopolitics. So as you mentioned, obviously, OPEC and its allies, so it's obviously Saudi Arabia and Russia being the key members there, they're heading into a second day of talks. Now, from what we know, traders and analysts are widely expecting them to put a pause on the originally planned increase of 400,000 barrels a day returning to the market. Now, there's a couple of reasons for that. Obviously, the discovery of the Omicron variant is very concerning for the market. Obviously, what happened last year when the globe was plunged into various lockdowns and mobility absolutely tumbled was that consumption fell as well hugely. And obviously OPEC's going to be very, very cautious in its approach because they're going to want to avoid at all costs a repeat of what happened last year. So futures are up a little bit this morning. It's going to be really interesting, obviously, to see what they come up with. Yesterday, what happened was that there was a meeting of a technical committee. Make any decisions, that those will all be taken today. But what they did say was that they estimated the market's going to be in surplus next year.
Helen, thank you so much. A fantastic preview of what to expect possibly. Maybe it is just a pause from OPEC later today. That's, of course, our energy and commodities editor, Helen Robinson. Just a quick check on oil for you. We're looking at WTI up higher by 2%. Crude is also higher by 2% as well. This came right as both of them in a bear market or are on the verge of a bear market. Really is one of these risk assets we've seen beaten up with equities as we get this concern over demand and what the new variant means. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we're going to discuss vaccine access with the co-chair of COVAX. But up next, first, we have the European Investment Bank's head of the economic department who's joining us. We're going to talk all about the business environment for Europe. Send in your questions, IB plus TV Go. This is Bloomberg.
Esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Omicron variant spreads. The U.S. reports its first case. Anthony Fauci says it was a matter of time. Apple drags tech lower after a supply crunch. Bloomberg learns that the iPhone maker now faces a new problem, slowing demand. And stay with Surveillance Early Edition. We speak to the economic head at the European Investment Bank and to the co-chair of COVAX. Send in your questions on IB plus TV Go. Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. London. It continues to be a negative day in these European equity markets. Much of it has to do with catch-up to what we saw U.S. markets do yesterday. It's this continued shift to hawkishness from Powell at the same time. It's the spread of Omicron. At the end of the day, it's just uncertainty, plain and simple uncertainty. That means there's not a lot of conviction, and with richly priced markets often using it as an excuse to sell. We're also looking at the lira heading towards new low with the finance minister replaced once again. Let's stick with that Omicron story, which has officially reached the U.S. The CDC has confirmed a case in California. The patient was fully vaccinated, has mild symptoms that are improving, and is currently self-isolating. Top U.S. infectious disease doctor Anthony Fauci was hardly surprised by the development.
We knew that it was just a matter of time before the first case of Omicron would be detected in the United States.
Now, over at the Fed, Loretta Mester says she's open to faster tapering to win space for potential rate hikes. The Cleveland Fed president told Bloomberg exclusively that higher rates in 2022 may be needed.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, you know, we have to be in a position that if we need to raise rates, you know, a couple of times next year, we're able to do that. So again, you know, quickening the tapering gives us that optionality.
Let's now focus on Europe, where companies are looking forward to expanding again. That's one of the conclusions of a new survey published today by the European Investment Bank, the EU's long-term lending institution. Among its other findings, EU and national responses to the COVID crisis have helped keep businesses open and shielded their investments. On climate change, 43% of EU firms said they have already made climate-related investments, more than in the U.S., and 46% said they have become used to they've used the crisis, to become more digitized. Well, joining me now from Luxembourg is Deborah Revoltella. She's the director of the economics department at the EIB. Deborah, thanks so much for joining us this morning. Let's start with one of those main points here. We're making our way through the pandemic. It's perhaps not gone, but it's started to normalize. And what sort of position do European businesses find themselves in?
I think what we see is that European firms are now in a good foot to restart and to catch the opportunities of the recovery. But we still see some risk in front of us. So far, so good. The policy support deployed by the European Union and by member states helped the firm to react to the shock. We see 49% of firms that have been experiencing a sales drop during the crisis, but also 56% receiving a form of support, either in terms of subsidies or temporary delayed in payment or guarantee credits. And this policy support has been quite important because it helped firms to hold to their investment plans, shielding the effect of the sales drop for them. So what we see is really that the policy support has been instrumental to keep firms focused on investment activities, which is what you need after a crisis like the one that we have seen.
And there's, of course, renewed concern that in Europe, a lot of this demand weakness is going to continue because we're seeing new mobility restrictions put on, new travel restrictions put on. What have you learned in looking over the past year how firms have reacted to support in order what's necessary to make sure that they survive potentially another wave of lockdowns?
What we've seen is that European firms have also taken the opportunity to transform in this phase of the crisis. 46% of firms have made investment to become more digital. This, we speak about starting a digitalization journey. They have been starting to sell online, work remotely, but not advancing digitalization. But this is a good starting point for the future, for adapting to a much more accelerated transformation of the digital work. What we are concerned, however, is that asymmetries across firms are increasing, and there is still 26% of firms that didn't do anything. And there is a group of firms which have been touched by the crisis. It may be an issue of some specific sectors, but we are concerned on what will happen to these firms in the moment in which the policy support will somehow be reduced. On the other side, another element that we are looking at is related to skills, and the skills remain.
Apologies for interrupting you. I definitely want to get into skills, but I just wanted to pick up on one note you mentioned before we move on to that. And that's this idea of what happens when support is removed. A lot of the companies you talk about are coming out in a pretty strong position, but how at risk are we of seeing many zombie companies in Europe?
So far we didn't see, but there may be a lot also related to the policy support that has been helping firms in this phase. But what we see that is quite interesting is that the support was not wasted with zombie firm ex ante. So one of the things that we find is that in allocating the policy support, there were screening mechanisms to avoid to support the firms that were already zombie before. So there was no waste in this direction. But the concern of what will happen going forward for firms that have been strongly impacted and were not able to transform is still there, because so far we didn't see anything coming up. And actually the default rate of companies are much below normal times today.
Okay, well, let's get into that skill conversation and the labor shortage conversation as well. Just how big of an issue is this?
Since a few years, we find that lack of skills is the major impediment for European firms to invest. Actually, today, 80% of firms speak about a lack of skills as an impediment. And I think this is also a very interesting point to reflect on in this moment of the crisis. At the European level, the policy support was targeted to keep people on the job. So the furlough scheme allowed adjustment in terms of our work, but still keeping people attached to the job. It's a big difference to what happens in the US. And we see it in the labor market, where in the US, we now have a lot of friction in the rehiring phase after the big increase in unemployment. And in the Europe, we don't see it. But the problem that I see is that in the same time, we didn't see retraining of people. Actually, companies that were keeping people attached to the job, they were doing much less training. And in a labor market that needs some transformation and needs people to learn new skills related to digitalization on one side, or also to the climate transition.
Deborah, thank you so much for joining us. Unfortunately, we're out of time. Really fantastic to have you on the program today. That's Deborah Revolta, Head of Economics Department at the European Investment Bank, live there from Singapore. I want to bring us some breaking lines just crossing the terminal as well. The IOC, the International Olympic Committee team, has agreed to a personal meeting with Peng Shuai in January. This is, of course, the Chinese tennis star where there were concerns about being able to hear from her. The IOC also says it held another video call with Peng Shuai as well. Of course, this comes at a time when the WTA, the Women's Tennis Authority, has been looking at potentially handling this through China as well. Now, coming up, we're going to be talking to the co-chair of COVAX about the distribution of vaccines in the shadow of a fresh mutation. That's next. This is Bloomberg.
reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Additional mutations, but the clinical significance of those mutations is unknown. So I think we really have to wait for the data, and I don't expect that there is a significant drop. If there is a significant drop, then Pfizer has a playbook to develop a new vaccine.
Pfizer's Ralph Renner there speaking to Bloomberg earlier. Now, sticking on Omicron and vaccines, richer countries have been responding to the Omicron threat by ramping up booster shots, which is precisely the opposite of what the COVAX vaccine initiative thinks they should be doing. One of the executives behind the UN-backed scheme insisted the priority should be inoculating people in developing nations. For more on this, we pass it over to our European correspondent in Brussels, Maria Tadeo. Hi, Maria.
Yes, Danny, and this is such a timely debate. And of course, you know, what a joy that we're joined by Chrysoula Sakharopoulou, who is the co-chair of the COVAX initiative. You're also a doctor by training, so of course, you know what you're talking about. You know, I have to ask you, COVAX, this is where the richer nations provide vaccines for some of the poorest, but we're seeing all of these mutations happening. Is COVAX, in your opinion, at this point, working?
Yes, thank you very much for this question. Yes, I believe that COVAX is start to work because it has vaccines. That means the problem until now was the shortage of vaccine. You remember at the beginning of the crisis, the manufacturers had not vaccine to provide us. And the rich countries were the first who bought, and they bought a lot. So COVAX had a deal with the Serum Institute of India. But because of the catastrophic sanitary crisis in April 2020, COVAX had not vaccine to deliver.
Yeah.
So now we have the donation of the rich countries. We have the vaccine which are arriving from the manufacturers, and is the time where we accelerate the distribution. And if you see the news, 2 days ago, Seth Berkley, the president of Gavi, said that in 24 hours, COVAX distribute 11 million of doses. That means now we have vaccine, we accelerate.
So you don't buy this theory, because the criticism is that, yes, you know, the rich countries promise, but the fact that we're seeing mutations in South Africa, India, and so on, it shows that in reality, you know, this program at times looks like a failure. You don't think it's a failure?
It's not a failure. As I told you, I don't believe that is a failure of COVAX, but it's a responsibility of the manufacturers, but also we have to be honest. If at the beginning we didn't have vaccine, also if you create the best mechanism, you have to have something to deliver. Now that we have the vaccine, we can deliver, and the problem will be maybe the opposite, that we have a lot of vaccine, which are arriving in COVAX. Now we have to be careful because when we send in countries, in some poor countries, we have to ensure that the deployment can be successful.
And the hesitancy at times. And I have to ask, as a doctor, this is the question now. If you have to choose between a booster shot for someone already vaccinated or someone who's unvaccinated needs to receive the first dose, where should that vaccine go? The booster for a person or first-time vaccination?
Okay, now I will answer like a doctor. I prefer to give my dose to somebody who was not vaccinated.
Okay, that's a very strong.
I think that, listen, for me it's unacceptable. We explain, the scientists explained that this is a pandemic. And when you have this pandemic, we have to be vaccinated, all of us. We have to stop to think that because we are vaccinated, the problem is resolved. No. And of course, it's unacceptable that the African continent is only 7% vaccinated.
And you say my booster would go to a first-time vaccination. Yes. That would be your choice. And I also have to ask you, the European Union, once again, is getting a lot of blame over the IP. Should the IP, the copyright of some of these vaccines, be removed? That's a real debate now. Should we remove the IP to accelerate production, perhaps?
In this crisis, I have to be honest, I'm very, very proud to be a European citizen because Europe has carried the global solidarity from the beginning. We create COVAX. We create the mechanism of donation. America said that the big America first. This was the Trump's America. Of course, now with Biden administration, they are back. We are very happy that we work together. Let's talk about intellectual property. For me, intellectual property has not to be the limit for the vaccination. So, the WTO, the World Trade Organization, has to take a decision. But we have to work also with the industry. And we have to find a compromise. President Biden announced that he was in favor of lifting of patents, but he didn't do a proposal. European Union did a proposal.
So you're saying America has all talk but very little action until now?
It's not, I think that the announcement is good, but I want to see the proposal.
What do you say, just very briefly, to some that say you're trying to protect European companies? BioNTech is a German company. That's why the EU is not giving away the IP. Just very briefly, is that a concern, the damage that it could do to a company like BioNTech, the money they could lose?
No, because, I don't work for the industry.
Okay.
First of all, I never worked for the industry, neither like a doctor, neither today. The question is that the innovation is very important. The research is very important. But I think the industry has also a responsibility. So I believe, as European Union, we believe the first scenario is encourage the voluntary licensing, like the example of AstraZeneca in India. Because the reset, yes.
But you're saying, of course, since we're out of time, you're saying it's not about protecting Germany's economic interests and you don't work for the industry. You make that very clear. And we want to thank you, of course, for your time. And we hope to see you back on the show. Chrysoula Sakharopoulou, she is, of course, the co-chair of the COVAX Shareholder Council. Danny?
Maria, thank you so much. Maria Tadeo there. A very fascinating conversation with the co-chair of COVAX about mostly the importance of getting vaccines to emerging countries. Now let's go over to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Hermes is set to join one of Europe's main equity benchmarks, further bolstering the French luxury company's visibility among investors. The maker of Birkin handbags is to replace Universal Music in the Euro Stoxx 50, effective from December the 20th. Hermes has been benefiting from a boom in luxury demand that accelerated during the pandemic. And UniCredit is planning around 3,000 more job cuts as its CEO, Andrea Orcel, focuses on profitable business after an era of restructuring. Sources tell us that many of the cuts will come from the Italian lender's corporate center to reduce bureaucracy. Orcel is also set to boost the bank's current dividend policy and focus on more lucrative products. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Leanne Gerrans there. Now, coming up, first, it was a global supply crunch. Now, Apple faces a different problem, slowing demand for the iPhone 13. We have that story for you next. This is Bloomberg.
Think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to a Bloomberg scoop. And Apple, suffering from the global supply crunch, is now confronting a different problem. That's slowing demand. The company is said to have told its component suppliers that demand for the iPhone 13 lineup has weakened, signaling that some consumers have given up trying to get the hard-to-find device. Apple is down pre-market. For more, let's get over to Bloomberg Quick Takes' Alex Webb. Alex, what is driving this, or what do we know about what's driving this weakening demand?
So there are two things happening here. Firstly, we know that Apple has told its suppliers that it isn't going to be able to make as many iPhones as it wants because it hasn't been able to get all the components, not least semiconductors. We know about the big global semiconductor crunch at the moment. Now, the effect of that is that they had hoped that demand, even if they couldn't satisfy demand at the moment, they would be able to do it next year and the demand would still be there. Problem is, the further you get into next year, the closer you get to the new iPhone. And frankly, the iPhone 13 wasn't a significant upgrade on its predecessor. The next one is expected to be a more significant jump. So perhaps consumers are sitting there going, well, I don't want to be getting a phone in February, March, when I could be getting an even better one come September, October, November. And so Apple is now telling its suppliers it doesn't think that demand it had hoped would arrive in the first half of next year will be as resilient.
Alex, we're also looking at this breaking story, a story that broke in the past hour of another Apple-related story. Its partner Foxconn in talks to help Saudi Arabia build EVs. What's the background to this one?
With another Debbie Wu scoop. She's responsible for the other Apple scoop too. So Foxconn, which manufactures a lot of the iPhones for Apple under contract in China, it has also been accelerating into the automotive space. We know that with electric vehicles, it's a lot less complex to build a car than it is with combustion engines. And so that has lowered the barrier to entry, made it easier, in particular for third-party contract manufacturers to build them. Saudi wants to build a domestic automotive industry. It's invested quite heavily in Lucid Motors, an EV startup. And now the story says that they are talking with, Saudi is talking with Foxconn about building a factory in its home country that can build a domestic electric vehicle.
Alex, thanks so much. Everything from hardware to EVs. On top of it all, that's Bloomberg Quick Takes Alex Webb. Now, let's go ahead and check on these markets as we close out the hour, continuing to see negativity in the European session. Not as severe as we saw in yesterday's U.S. session, but still drops of nearly 1%. Because of that Apple story, we're looking at tech as the biggest drag. Now, Surveillance Early Edition continues in the next hour. This will continue to be a conversation as markets try to find their way through this continued pandemic. This is Bloomberg.
目前眼前状对我们军方来讲的话，我只跟委员报告，是我从军以来40多年以来看到真的是最严峻的时候。要翻台的话，他目前有这能力，都有的啊，但是要看怎么一个结局。说我们不做任何挑衅啊，但是说把他激怒了，就跟我们人一样，你把我激怒了，我手上能力我也会发挥出来。所以2025是我们研判要全面啊，我们这样研判的。
Well, China has, I've spoken with Xi about Taiwan. We agree we will abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
The October jobs report beat expectations for job creation.
We're experiencing the strongest economic recovery in the world.
Will we get another great jobs report for the holidays? Find out Friday on Bloomberg Television and Radio. People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Whether it's Omicron or Delta or any of the variants, we know that vaccines are likely to have some protection.
It's too early to know precisely the impact economically. We need to learn more about the transmissibility and the severity of this variant.
We're learning more every single day, and we'll fight this variant with science and speed, not chaos and confusion.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, December the 2nd. Our top stories today. Is it time to buy the dip? JP Morgan says market turmoil caused by the Omicron variant may offer investors an entry point. Decision day for OPEC Plus. The cartel and its allies are debating whether to call a halt to their oil production increases. And Apple hits another speed bump. The company tells suppliers that consumer demand for the newest iPhone is slowing down. Welcome, everybody, to Bloomberg Surveillance Early Edition. I'm Anna Edwards, live in London. And Kayleigh, really interesting to see. Actually, the new information at the margin around the new variant has actually been quite positive, whether it's the WHO or GlaxoSmithKline or our conversations with Pfizer. That's not helping European markets, though.
Yeah, I wonder if European markets are just catching up to the selling we saw later on in the U.S. session yesterday. That said, the picture does look a little bit better this morning. It looked decent in Asia, a bit mixed when it comes to the equity gauges. Japan was lower, but China and Hong Kong were higher. And all said and done, the MSCI Asia Pacific Index did close in positive territory, but only by about 0.25%. And some of the biggest underperformers within the Asian session were suppliers to Apple. And that is after Bloomberg reported that Apple has told its suppliers that demand for the iPhone 13 is slowing down. So that weighed on the likes of LG Innotek, which was down about 8.4% in South Korea. Now, interesting action in the bond market as well, specifically at the shorter end of the curve in New Zealand. The 2-year yield up about 8.5 basis points to 194. And then the Japanese yen not getting any kind of safe haven bid today. It is the biggest underperformer in both Asia and G10, weaker against the U.S. dollar by about 0.33%, sitting at 113.15. Now, here in the U.S., we did see that late selling yesterday. It got uglier as the session grew older. And as a result, the S&P 500 is coming off of its worst 2-day decline since all the way back in October of 2020. This morning, though, there does seem to be a little bit of dip buying action. We will see if it holds. Right now, S&P 500 futures up about 0.3%. In the bond market, a bit of a reversal from yesterday as well. Yields moving higher by the better part of 4 basis points on the 10-year Treasury to 144. Still, though, more movement at the shorter end and through the belly of the curve as a result. That yield curve is still flatter on the day. The 530 spread now sitting at 58 or so basis points, just south of 59, which is the flattest since March of 2020. And then, of course, all eyes will be on oil today. What will OPEC Plus decide to do in the face of the Omicron variant? Do they decide to just hold production steady in the month of January? That will, of course, provide a major cue for the oil price. But right now, prices are moving higher, Matt, up 2.6% on WTI. Yeah. We're trading at $67.25 a barrel.
Yeah, that'll be very interesting to see if they perceive Omicron as actually denting demand rather than just a big news story that we talk about every day. Take a look at what's going on in Europe in terms of stocks. A little bit of a mixed picture, but for the most part down, with the major indexes off about 1%, the DAX off about 1%, the CAC 0.75%, the FTSE down about 0.2% right now. The interesting thing really is in the currency story. The Turkish lira being first and foremost a big headline this morning after Erdogan has abruptly let go of his finance minister, replacing him after only 12 months on the job amid a debate inside the administration about the aggressive rate of interest rate cuts and how that's fueling inflation, how that is undermining the currency. Of course, we know that the Turkish president, Erdogan, doesn't believe that cuts are fueling inflation. In fact, he thinks lower interest rates will help to fight inflation. Here you see the lira, 13.5 right now is the amount you can buy for $1. I also thought it's interesting you're seeing some strength in the pound against the greenback, although the dollar is just generally weaker today, stronger against the yen, but generally weaker against other major trading partners. I've got Brent as well right now at 70.59, so I'm watching oil as well, up 2.5%. Will be interesting to see how the Omicron variant affects OPEC's decision. And then Bitcoin has been doing a whole lot of nothing lately, but we're looking at positive futures, Kaylee, you just showed us in the U.S., and that's not helping that kind of risk-on sentiment in America, not helping Bitcoin, maybe because stocks in Europe and are taking a little bit of a hit.
Yeah, absolutely. Really difficult to get a sense of how risk on or risk off we're feeling at the margin here in the global conversation, because, of course, we've got these European assets just simply playing catch up, it seems, or catch down with the Wall Street story from yesterday. Now a look at what is ahead today. We've mentioned it a couple of times. OPEC Plus ministers meeting today to decide on the group's production policy for the next month. The market expects a pause in output. Now at 8:30 a.m. New York time, we'll get U.S. initial jobless claims, and at 11:30, San Francisco Fed's Mary Daly and Richmond Fed's Tom Barkin discuss the labor market and inflationary pressures, two crucial angles for the Fed, of course, at a virtual event of the Peterson Institute. We will also hear from Atlanta Fed President Raphael Bostic and Fed Governor Randy Qualls today. I mean, that's pretty much everybody, isn't it? That's a lot of Fed governors all in one day. So lots, I'm sure they will have to say on where they see the world right now and what Omicron could do. Let's think about what Omicron could do. The first confirmed U.S. case of the Omicron coronavirus variant has been detected now in California. The CDC says the patient is a San Francisco resident who traveled from South Africa. They were fully vaccinated and have only mild symptoms. Meanwhile, GlaxoSmithKline says its COVID-19 antibody treatment looks to be effective against the Omicron variant in early testing, and Pfizer says it expects its vaccine to hold up against the new variants. I spoke with Pfizer's Vice President Ralph Reinert earlier today.
There are some additional mutations, but the clinical significance of those mutations is unknown. So I think we really have to wait for the data, and I don't expect that there is a significant drop. If there is a significant drop, then Pfizer has a playbook to develop a new vaccine.
So, as I was saying earlier, some of the most recent information around Omicron does not seem to be as gloomy as perhaps it has been in other days. But what does this mean for volatility, for investors? Investors are bracing for more volatility as the Omicron variant complicates the outlook for the pandemic recovery. A lot we don't know still. Bloomberg's Danny Berger has the latest on the market response. And the market response is pretty confused today across the Atlantic then. Danny, what are you seeing?
Confused is probably a good adjective to use for the past few days. And look, yesterday, a market sell-off sparked by a case in the U.S. of Omicron is not a surprise to a lot of people. So if anything, this really shows just how fragile markets are at this moment. It's not just a new variant, it's also Powell starting to shift this more hawkish direction at a time where assets were already very richly priced. Puts, also protection on this equity market has been very cheap. So this is what it's resulted in. For our radio listening audience, I have both the VIX and the MOVE, both measures of volatility for the stock and bond market, up on the screen in front of me. Both of them have ever so slightly started to creep higher, and I should say for equities, it was quite a big move higher as well. So if puts are cheap, it makes sense to hedge yourself at this moment because uncertainty, along with confusion, that seems to be the word of the day. We're heading into the end of the year. So for a lot of people, especially hedge funds, which according to Goldman Sachs are at a year low position, have started to close out their positions saying, okay, I'm just going to stay on the sidelines for the rest of this year.
All right, Danny, but some strategists are saying don't stay on the sidelines. Now could be an excellent buying opportunity.
Yeah, for those who are brave and think we'll still get buying the dip versus selling the rallies, now is a great time. And Marko Kolanovic from JP Morgan, along with his team, think that this is the current case we find ourselves in. Not just buying the dip, but this is actually a good thing. He says Omicron could be a catalyst for steepening, not flattening the yield curve, rotation from growth to value, a sell-off in COVID and lockdown beneficiaries, and rally in the reopening themes. He thinks that because Omicron is weaker, even though it might spread more, that it would be good. The recent sell-offs, these segments, it's an opportunity to buy the dip in cyclicals, commodities, reopening themes. And of course, when you think about about cyclicals, you have to talk about the European markets. Bloomberg, we just did our survey of year-end for 2022 estimates, kind of similar to what Marko Kolanovic is saying. We're seeing gains of 9% through year-end of 2022, according to this survey. The biggest growth of which, Anna, that's analysts see here, is really robust earnings for these European equities.
Will we still be saying the word Omicron at the end of 2022? I really hope not. Danny, thank you very much. Danny Berger with us on the latest on market expectations around Omicron. Of course, the Fed very much in there as well. Now the latest Bloomberg scoop. Apple, suffering from the global supply crunch, is now confronting a different kind of problem, slowing demand. Bloomberg has learned the company has told suppliers that demand for the iPhone 13 lineup has weakened, signaling that maybe some consumers have given up trying to get hold of those hard-to-find devices. Tom McKenzie joins us now. And Tom, good morning. So what is it that we've learned then from our sources about what is the outlook from Apple?
Apple is becoming a really fascinating example of these evolving supply-demand pictures and what is happening within this environment. So we know, you'll remember this, that they cut their forecast for total units in terms of the iPhone 13 by about 10 million units because of supply constraints, because they couldn't get hold of chips and other components that go into the iPhone 13. Now they've turned around and said to suppliers, well, the demand is starting to fall off. People are deciding they're not going to go out and buy the iPhone 13. You can imagine part of this is down to the fact that you have to wait weeks, months in some cases to get your hands on these products. So some consumers just holding off, not bothering to do that. Inflation, of course, another factor as well, at about 6% in the US across the board, so maybe pressure on consumers there. Apple had hoped that come next year, you'd have seen that demand pick up and make up for that lost production that we're seeing in 2021. It doesn't look like that's going to happen.
Yep, well, maybe it's inflation, right? Maybe it's fear of the Omicron variant. We really don't know what's driving consumer behavior. It could be that they just don't love the iPhone 13.
It absolutely could be that. Look, the changes around the iPhone 13, as you know, Matt, were not seen as significant or particularly material. So maybe it's a question of consumers waiting amid these drawn-out wait times for these iPhone 13s, waiting until 2022 when you can get the new model coming out. Maybe the iPhone 14 is what they're going to call it, which is expected to have more souped-up features. So that could definitely be a component. It's worth pointing out, they're going to have a very good season, a very good holiday season. The analysts expect the third quarter, the revenues will come in up 6% at about $118 billion US. It's just not going to be the blowout blockbuster that Apple had hoped for in the earlier part of this year.
Tom, thanks very much. Bloomberg's Tom McKenzie there, covering the big tech story of the day for us. Let's get to politics now in Washington, D.C. The federal government moved another day closer to a brief weekend shutdown, with congressional Democrats and Republicans still struggling to agree on a stopgap measure before Friday's deadline. Jack Fitzpatrick, Bloomberg government reporter, joins us from Washington. Jack, so what does it look like? Will the government shut down?
It's looking more and more likely that there's going to be a probably brief shutdown. There's a fight over Senate conservatives trying to hold up a stopgap funding measure, saying that they want to insert a measure that would block vaccine mandates, the OSHA vaccine and testing rule. If they want to hold this up, even if there are 60 votes to end debate, the procedural issues in the Senate could drag this out definitely past Friday. There are some other separate issues, so we don't even have a stopgap measure that has been released yet. So there are a few things they're working through, and the question is how fast can they introduce it, get it through the House, and then work with Senators Roger Marshall, Ted Cruz, Mike Lee to see if there's any kind of deal that could happen. But yes, as of right now, unless something changes, at least probably a couple-day shutdown is likely.
Well, Jack, just down the street from the Capitol building is the Supreme Court, which heard arguments yesterday in Mississippi's abortion ban after 15 weeks of pregnancy, indicating they may be poised to roll back abortion rights. What would the implications of that be from an electoral standpoint as we look ahead to the midterms in 2022?
There would be a lot of significant implications. Obviously, Supreme Court watchers have said that a lot of the indications, especially from the three new conservative judges, were that they appear to be considering taking out that Roe v. Wade precedent. Electorally, this would be a massively motivating issue for Democrats. It's too early to say if this would undo the struggles that you've seen in the polls for Democrats heading into the 2022 midterms, but clearly it would be a defining issue. And it would also complicate a lot of other issues. One of these government funding debates is over the Hyde Amendment, which restricts federal funding for abortion. It would open up a major can of worms, but also be a motivating factor, probably for both sides, especially Democrats, in 2022.
All right, well, we will look ahead to that decision from the Supreme Court expected later on this summer. Thank you so much to Jack Fitzpatrick of Bloomberg Government. And now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big one to the upside is Snowflake, of course, the cloud software company. It reported after the bell yesterday, positive on revenue, and the guidance also was really strong. So as a result, that stock up about 15% in early hours. Another stock higher is Vir Biotechnology. And of course, we were reporting that GlaxoSmithKline's COVID-19 antibody treatment does look like it actually works against the Omicron variant, and its co-developer of that drug is this company, and as a result, those shares are up about 6.6% in early hours. One mover to the downside, though, is a COVID-19 vaccine maker, Moderna. It could be lower for a third day in a row. It's already lost about 16% over the last 2 days. It's down another 4.4% this morning. Part of this is concern around efficacy against the variant, but also some legal issues with them losing a battle yesterday, Anna.
Yeah, absolutely. We'll keep an eye on Moderna. Interesting, we spoke to Pfizer. We played a clip of it earlier, didn't we? A slightly more positive take on the effectiveness expectations around their vaccine. Sticking with the subject of Omicron, I just want to get to a briefing that's taking place. The WHO operating a briefing on WHO Africa, this is. They're saying, they're giving us their take really on what we know so far about Omicron, urging countries to accelerate genomic sequencing, also saying more than 80% in Africa haven't had a single vaccine dose. We're hearing from Professor Anne von Gottberg, clinical microbiologist at the National Institute for Communicable Diseases in South Africa. She's giving a fairly gloomy take, actually, saying that previous infection doesn't protect from Omicron. I suppose we've anecdotally heard of other people, maybe some of us know other people who also have had other branches of this virus twice. So we will see whether that is as substantial as perhaps that sounds. We'll get further details on that. We'll keep monitoring this briefing. Coming up on the program then, returning towards record lows, more on the weakness in the Turkish lira. And should investors buy that dip? We talked about it earlier with Danny. We'll speak with Willem Sells, HSBC Private Banking Global CIO. Plus, it's decision day for OPEC Plus, and all options are on the table. More ahead. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Kaylee Lyons in New York and Anna Edwards in London. Now, we've been watching the Turkish lira hit record lows again and again lately as President Erdogan reiterates in various ways his view that cutting rates is the best way to fight inflation and stem the drops in the currency. Now, every day Mr. Market doubts him, and most recently Turkey has actually intervened in currency markets for the first time in 7 years to try and stop the drop. Now, I've got a chart here which I will explain for those listening on London DAB Digital Radio. Good morning to you. It shows Turkey's net reserves. This is how much they essentially have in their war chest. Now, the gross number would be negative, so we're using the net to show you it's about $25 billion. This is essentially what they have left to use if Mr. Market says, all right, I'll take you on in that fight. Let's talk to Ven Ram about it, currency and rate strategist at Bloomberg MLive. Ven, so we know that President Erdogan most recently has dismissed his finance minister. This is another chance, I guess, for the market to take on Turkey.
Absolutely, Matt. I mean, they, as you mentioned, they intervened for the first time in 7 years yesterday. They're kind of signaling to the markets that here, we are ready for a fight if you want it. And I don't know if that's great messaging because, you know, considering the reserves that they have, whether you look at the gross reserves or the net reserves, they do not have a very big war chest. And if you look at it in the context of the imports of the nation, it's hardly enough to cover a few months of imports. And against that backdrop, you don't go into the markets and say, we are going to intervene and defend the lira at a time when you've got deeply negative real rates and at a time when the Fed is looking to go faster on its taper and start raising rates. That's hardly an environment in which you would take on the markets. But there you go, that's what they are doing. And we have already seen the lira. Yesterday, it pulled back. Now it's it's coming back down again.
Yeah, it supported the lira for a little while, didn't it? But it didn't last all that long. Ven, pivoting to the risk-on, risk-off trades that we're seeing in FX markets at the moment, risk-off days seem to be good for the euro. We've been talking about this since last week when we were really puzzled. There have been a few suggestions, and you've been doing some thinking on this. What's your assumption? What are you suggesting is the reason behind this?
Now, we saw this, Anna, play out in 2020, actually. So if you look at what happened immediately after the pandemic, rates collapsed around the world, and it was the euro that was bid. It wasn't the dollar, and we are seeing that playbook being played all over again now. And I do think that if there is going to be a severe risk-off with Omicron, and i.e., what do I mean by the severe risk-off? It is defined by the Fed going slow on taper and not raising rates. That would mean a bid for the euro.
Ven, thanks so much. Ven Ram of the Bloomberg Markets Live team. Thank you very much. Remember, you can get market analysis. MLive Go is the function to use on your terminal. This is Bloomberg.
Extra $1 trillion in spending not increase inflation?
by increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kayleigh Lyons in New York. The WHO Africa is holding a press conference team, and then we brought headlines earlier on that suggested that previous infection was not helping against Omicron. But then we see other headlines coming from it saying that certain parts of South Africa may see lower rates because of previous infection, Kayleigh.
Yeah, and vaccination. So some conflicting guidance here. Of course, we all are just awaiting more clear data, and we understand it could take more days and weeks for us to get that picture, Anna.
Coming up, conversation with Willem Selves. We'll talk to him about investments. This is Bloomberg.
There's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp. All right, perfect. In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kaylee Lines in New York. And Matt, we're monitoring this press conference taking place, WHO Africa leading a press conference, the WHO there, and some seemingly concerning lines, perhaps weighing on risk appetite just at the margin. We saw a bit of a dip in futures as a result of some of these lines, but then that dip being bought. So we are keenly waiting for anything we can really treat as fact, I suppose, when it comes to the Omicron variant.
Yeah. Some conflicting headlines coming across. I thought it was concerning that we heard from Professor Dr. Gottberg that previous infections don't protect against Omicron. Now we know that typically, at least from a layman's understanding, previous infections or vaccines should protect at least somewhat against new infections. But if the previous infections don't help you, then you have to wonder if vaccines are going to help at all either, because it's all about the antibodies, right? Maybe Professor Dr. Gottberg meant to nuance that a little bit.
Yeah, I mean, and then we're back to asking a lot of questions, aren't we, about the effectiveness of vaccines? And as we played it earlier on in the program, we asked Pfizer a little bit earlier on European time about that, and that they seem to express some confidence that we wouldn't see a material drop-off in effectiveness of the vaccine. But we'll wait to see. Some differing opinions then coming through from this WHO Africa panel. How's that weighing on markets or not, Kaylee, as we head towards the start of US trade?
Well, it really just speaks to the broader uncertainty around this variant, its transmissibility, its lethality, and what we know is that the market really doesn't like uncertainty. So that has driven it a little bit crazy in the last several sessions. And of course, that led to the worst two-day performance for the S&P 500 going all the way back to October of 2020. It is looking a little bit better on the US side this morning. Futures up about 0.5%, but stocks are down in Europe. Every single sector in the Stock 600 in the red. Technology actually leading the losses. That broader index down about 1.2%. But we have to keep in mind a lot of the selling pressure was late in the US session yesterday. So Europe may be playing a little bit of catch up on that front. In the bond market, yields are moving higher, though, off of the highs of the session. We're up the better part of 3 basis points on the 10-year Treasury yield to 143. And then, of course, all eyes will be on OPEC Plus today and their output decision for January. Does the Omicron variant mean that they decide to hold instead of adding another 400,000 barrels a day to its output? It'll be interesting to see what that does to the oil price. Oil, of course, is in a bear market, but right now, Brent crude is up the better part of 2%. $70.19 a barrel is where we trade at the moment. And of course, one of the big individual company stories we're following today is when it comes to Apple. Apple reportedly telling suppliers that demand for its iPhone 13 is slowing down. So that is weighing on that stock. It's down about 2% in pre-market trading, and its suppliers lower as well. The likes of Qorvo, Skyworks Solutions, and Qualcomm all down about 1% or more. Matt?
I have one of the coolest charts I've seen in a long time here, courtesy of my London producer, Daniel Curtis. I'm not sure if he stole this from Cameron Crees or not, but it's just amazing. Yesterday, the volatility that we saw, you know, the S&P shooting up more than 1% gain and then dropping on the incredibly obvious headline that someone in America has the Omicron variant of the virus. It seemed to me so amazing, that kind of volatility. And in fact, it's pretty unprecedented. This chart shows, for those of you listening on Bloomberg Radio, we've only seen it happen 17 times since the 1990s, 1980s. This kind of rise from a close the day before and then drop into negative territory. And some of those times were like the long-term management crisis, the great financial crisis, the China concerns about Chinese defaults. So there's been pretty major issues that have forced that kind of volatility in the market, and yesterday was one of those days. Willem Sells joins us, HSBC Private Banking Global CIO. Willem, what does it tell us about how this market is priced that an incredibly obvious headline, something I think we all would have guessed is the case, drives a 2% and change sell-off in the S&P 500?
Yeah, we've had an almost uninterrupted rally, of course, this year in the S&P, and obviously there's always a little bit of temptation to take some profit here, you know, especially as there are so many different variables. You know, obviously we're now talking about Omicron, and clearly there the jury is still out. The data is not yet in on the final verdict on whether it is spreading more quickly, whether it's more deadly. And then at the same time, obviously we have OPEC. We also have you know, the Fed and other central banks potentially changing their tone. I think what people need to keep in mind for 2022 as a whole is that we're still in the mid-cycle, so growth of the economy and of earnings should still be decent. And even if central banks start to hike a little bit, rates still remain low. So it is still a positive environment, but obviously more volatility in store, and you need to build resilient portfolios.
Willem, good morning. So how fundamental are the changes we're going to see from central banks? Because we have seen this pivot from the Fed. It's either hawkish or less dovish, depending on your interpretation, but a bit of a change in tone from the Federal Reserve. Where does that take us back to? Does that take us back, in terms of the accommodative nature of policy, does it take us back to a pre-COVID period eventually? Is that where we should set our sights, or tighter than that?
It's a transition that is taking place, you know, both on the monetary and on the fiscal side, by the way, and it's taking place around the world. And so far, obviously, people, you know, central banks have been looking at it as transitory. Now we can no longer use that word. People are still thinking that it will fall in the second half of the year. Inflation will fall, and that's also our core case. But there's more uncertainty around this. So we're seeing tapering happening more quickly, and therefore also rate hikes starting, you know, next year as well. But it's still a low-rate environment, and especially what's important for investors as well is to look at what a 10-year does, the 10-year Treasury, and we see that in a very volatile but range of 1% to 2%, so no drift. So we're actually still buyers of growth stocks. I think that's a bit out of consensus.
Okay, so no higher than 2%. 1.43 is where we trade on the US 10-year. What stops it from going any higher than that?
It's, you know, to some extent the expectation, obviously, that inflation will fall. You know, there is the impact of technology, for example, that is deflationary. There is the, you know, the labor market, which has become, you know, more global, certainly for people like us. You know, I have team members that have been sitting at home and have been sitting abroad for a long time. So, you know, the offshoring question is an obvious one, you know, around the world. Obviously, there are jobs that you need to do locally. Then there is the global savings surplus that is there, the global aging, etc. All of that, those structural forces keep it in that 1% to 2% range.
Willem, let's contrast what the Fed is doing with the ECB, which is growing a lot lonelier in a tightening world. How does that make you think differently about European assets relative to U.S. ones?
Well, for a start, obviously, it continues to help the US dollar, you know, which we think will continue to drift a little bit higher. Obviously, it has done already a lot over the last few months, you know, but a little bit of, you know, further upside for the US dollar, mainly because of that interest rate differential, that yield pickup that people are seeing. It's easier to find bonds in the US dollar market that are attractive, that have a decent yield for our type of clientele. I think when you look at the US versus Europe in the equity market, you need to think about what is the character of European stocks versus the US. And Europe has more cyclical stocks, and the US has more quality stocks. And so we don't particularly want to be too cyclical, and we want higher quality. So it points to us towards the US as the main overweight.
Points to the US. Willem, thanks very much. Thanks for joining us. Willem Sells of HSBC Private Banking with us on set here in London. Now, coming up on this programme, it is decision day for OPEC+. We will speak to Martin Ratz, global oil strategist at Morgan Stanley. Will OPEC+ decide to pause its output hikes? We'll get to that conversation next. This is Bloomberg.
You should be thinking about formerly incarcerated people as representative of their families also and of their communities. These are human beings. They're not disposable items. They are not to be warehoused, locked away, out of sight, out of mind. And so I'm out here in the public because I am the conscience of those folks who, of America, I hope. I'm hoping to prick their conscience and know that I am just a symbol of a much greater problem.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Anna Edwards in London and Kayleigh Lyons in New York. Now, Europe is facing an unprecedented energy crunch, and today energy ministers from across the bloc are meeting to discuss what to do to alleviate the pain. Italy is the latest EU member state warning about potential blackouts. For more, we go to our European correspondent, Maria Tadeo, live out of Brussels. So, Maria, I know prices are high, temperatures are dropping. How much of a concern is this?
Temperatures are dropping, and I'm not sure if you can see the snow behind me. And, you know, we're the start of December. This is going to be clearly a cold winter. And, Matt, you know, to answer the question, I think if you put away the mutation and the virus, which is, of course, the biggest question and the biggest concern for European governments, I would say the energy crisis ranks second. A lot of this, of course, feeds into the inflation narrative that we're seeing in Europe, whether this is a one-off or cooled down or not. But it also feeds into what is a very important debate in Europe, which is the social fabric. There's many governments that do worry about social pushback in the winter if households are not able to heat up their homes properly. And as you know, we could also be entering an election period next year in Europe if Mario Draghi decides to leave the Italian government. And then, of course, the big French election. A lot of this feeds into both the political but also the economic debate. And ministers are meeting today in Brussels hoping to come up with a joint solution. Some of the southern European countries are saying we need the EU to step in. The problem is until now, it does seem as every nation for itself, you have to come up with your own plan. There's going to be no joint European response for this.
Yeah, Maria, I should point out that is a window behind you. We didn't make you go stand in the snow with no coat on. That would have been cruel. You talk about, as you draw our attention to what looks like very cold weather, you mentioned government intervention, the possibility of that. Are there any signs of respite in prices then?
Well, you know, Anna, that was always a hope that prices would cool down, especially when you look at gas prices in Europe. And, you know, just don't take my word for it. Look at this chart that we've put together, which to me, this is a story, the energy crisis of Europe in 2021. If you look at December, that was last year, you see where prices in the gas market were trading at. You look at where we are now, this has rocketed by triple digits. If you look at the situation in Q4, starting in September, that's when the real crunch begins. We'll go back from the summer holidays, big concerns about reserves, but also Russian supply becoming very tight. The only meaningful decline we've had this year was Vladimir Putin saying that Gazprom would honor contracts, but as you can see, that's not really been reflected in the market ever since, and prices have continued to jump in what is already a cold winter. You know, you see the snow behind me, so you see that, you can take my word for it too.
All right, thank you so much to our European correspondent, Maria Tadeo in Brussels. And another key meeting for the energy world, it's decision day for OPEC and its allies. The cartel is heading into a second day of talks on production with the Omicron variant, a major wild card. Joining us now is Martin Ratz, global oil strategist and head of European energy research at Morgan Stanley. So Martin, I know you expect that OPEC Plus is going to decide to hold production steady in January. Why?
Yeah, that is the goal. Look, it's basically the default choice after you've excluded the other two choices, which are either to continue with the current trajectory of increasing output, which is the existing agreement as it is, or the other scenario is cutting output. Now, increasing output, given the uncertainty that exists around the Omicron variant, probably would not be appropriate. There's quite a bit of uncertainty about what it will really do to oil demand. OPEC's own supply-demand balances show a distinct weakening in the first quarter. So with that in mind, continuing simply with the path that OPEC is on and leaving the autopilot on, so to say, is probably not appropriate given the heightened level of uncertainty. But the other extreme outcome would be to actually implement an additional production cut. But the problem with that is that it's very hard to create consensus around that. And secondly, it would carry quite a lot of negative signaling value. I think the market will say, hey, what is OPEC really seeing there? And the market reaction to an actual cut could be surprisingly negative. So I think given the uncertainty, just keeping it flat seems to be the most appropriate course of action.
Yeah, I wonder, do we see any evidence that Omicron is actually affecting the market beyond, beyond the trade in, speculation, beyond media headlines? I mean, we're making a huge deal of it, right? But does anyone really say, I don't want to buy an iPhone because of Omicron? Does anybody really say, I'm not going to drive to my mom's house because of Omicron? Does it really affect consumer behavior?
Look, I think by now you have to be a little bit skeptical about this. The market is not taking this view. The market is trading as if this will lead to a very large amount of demand erosion in the early part of next year. But look, the sort of willingness of governments to put people into lockdowns has much diminished over the last sort of 12, 18 months. And then on top of that, people's willingness to then comply with these such very stringent rules is also increasingly running into popular resistance. So our thinking is that sure, jet fuel could be impacted when planes don't fly. But outside of jet fuel, the impact will be much diminished.
Okay, Martin, good morning. Before we were talking about Omicron, we were talking about strategic petroleum reserves and release by consumer nations to try and bring those prices down. Of course, we've seen those prices coming down drastically for other reasons. What kind of response do you think we'll get from OPEC Plus around that? What kind of response would they have given if Omicron had not been part of the conversation?
Yeah, so there's a great deal of tension, of course, between the objectives of the producing nations and the consuming nations, so to say. I think that the situation is such that we've arrived at a situation where actually the core OPEC countries, particularly those in the Middle East, are less sort of sensitive to pressures from the Western world, as in they also see the sort of climate agenda, the net zero agenda. They're sitting on a large amount of resource still, and arguably still a long window to monetize those resources, but somewhat of a shrinking window. And if you're in that situation, then you think, well, hang on a second, we probably have 10, 15 years sort of, of a solid oil market left. We need to extract as much economic rent out of those resources as possible, which is also important for those own countries sort of transition to whatever lies next. They need funds to organize their own transition, and therefore they're perhaps a little bit less sensitive to the demands of the consuming nations to drive prices down. I have to say also on the SPR release, we're talking about something that is sort of 1% of global observable inventories.
Yeah.
Simply moving 1% of inventories from an SPR tank to a non-SPR tank doesn't fundamentally change the oil market. So,
Yeah.
look,
Nothing compared to a new
it
variant.
doesn't change much.
Martin, we heard from JP Morgan earlier this week a report that made a little bit of noise saying Brent could hit 125 to 150 in 2023 because of a lack of spare capacity, specifically on the part of OPEC Plus. What is your read on what that spare capacity actually is?
Yeah, so estimates of spare capacity vary quite a lot. If you look at estimates from the IEA, it could be as much as 6 million barrels. But that still includes 800,000 barrels a day for Iraq, nearly 400,000 barrels a day for Nigeria. When you go country by country, those estimates seem very generous. There are other estimates from a wide range of consultants out there that put it a lot lower. Something like 3.5 million barrels a day based on October production is broadly where we would put it. And then, yeah, if you then roll the clock forward over the next year or so, even if you take a much more conservative view about what OPEC actually will do over the next year in terms of production additions, we can easily see them adding 1.5 million barrels a day of production. And so when you roll the clock forward to this time next year, we could be having spare capacity sub 2 million barrels a day. And that would be a very low level.
Martin, thank you very much. Thanks for joining us. Martin Ratz, Global Oil Strategist and Head of European Energy Research at Morgan Stanley. Sticking with that theme, coming up in later programming, more on OPEC with Jeff Curry, Goldman Sachs Global Head of Commodities Research. That is at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, but we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London and Matt Miller in Berlin. Tom Keene, co-anchor of Bloomberg Surveillance, also joining us now. So, Tom, we're looking at stocks, we're looking at bonds, but today especially commodities are also in focus.
Well, we're looking at oil. Bloomberg's done a phenomenal job, and behind the scenes, I mean, Matt Miller, he works like a 3-hour day, but we've got people really trying to book expert voices. And I want to brag here about the arc of the U.S. morning, from Martin Rotz, who you just heard from Morgan Stanley, over to Jeff Curry, who will be with us in, I think, the 10 o'clock hour New York time. And in the middle is the guy who says $150 a barrel oil is a scenario that's feasible. Christian Malek, and we'll have a great conversation with him here coming up on Surveillance. Of course, there's every other shock and awe as well. And, you know, Matt Miller, I'm sorry, we are all one-upped by the beautitude of Miss Lyons and Grant. Grant is, I mean, wow. I don't know what to say here. I think the thing is one part grizzly bear. I mean,
he does have massive paws, but he has the most adorable face, and he really is such a good puppy. We are very, very happy.
Well, good, and anybody that's dumb enough to name their dog Grant clearly needs a second dog named Lee. Let's go to the chart right now. And the chart is for Kaylee Lyons because she has no idea how the wallet's going to be lightened up here at the vet in the coming months. This is the juggernaut if you have a dog in America. And it's Chewy. I don't understand why Jeff Bezos hasn't bought Chewy. The green circle at the bottom is where the Lyons household decided to acquire Grant. Chewy took off like a rocket. And Matt Miller, it's ebbed away here a little bit. That's the lightening of the Lyons wallet at the veterinarian.
I must say, I did place a massive Chewy order last night, Tom, and we're going to the vet for the first time tomorrow, so I'm sure that will lighten the wallet even more.
That will lighten the wallet as well. So there you go. Congratulations on
Thank you very much.
Grant.
All right, Tom Keene of Bloomberg Surveillance, thank you. And I am mostly distracted by my puppy, but there are other things I am watching today, including that OPEC Plus meeting. It seems to be that the market is expecting that they will hold production steady in the month of January due to the uncertainty around the Omicron variant. I mean, it's so interesting, and Anna, you alluded to this. The other day, we were talking about supply and the release of reserves. Now it is much more a demand story, Matt, and we'll see how cautious OPEC Plus is around that.
Well, I have to say, I question whether or not this is really a demand story. I mean, when you were considering the purchase of Grant, did you take the Omicron variant into account? Was it out yet? Would you have decided differently had you known about Omicron then? I doubt it would have affected anyone's decisions, but we are making a huge deal out of it, and it is definitely creating real price action, so that can't be denied. We're hearing also a lot of conflicting statements about Omicron, specifically from Professor Dr. Gottberg in South Africa. Not sure 100% of her qualifications or if she's being quoted correctly, but she did say, or we did at least have a headline saying that she says previous infections don't protect you against Omicron. If that's the case, do vaccines do any good? It seems like that could be a little bit of misinformation, Anna.
We're still in the early scramble, trying to pull together a picture really of what this variant looks like, and that search for those leads, taking us in all kinds of directions. Let me just briefly mention we are seeing a meeting taking place between Secretary of State Antony Blinken and his Russian counterpart Sergei Lavrov. Lavrov saying further NATO expansion in the east threatens Russia. Blinken saying serious consequences if Russia pursues confrontation. We will keep monitoring this meeting for you. More Bloomberg Surveillance lies ahead. This is Bloomberg.
what do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
The Fed is already behind the curve.
Everything they're saying in the last month points to them getting much more serious on inflation.
We might even see core inflation at, I don't know, 6.5% potentially in February.
They're going to start that journey to normal, and we're going to help them on that path.
The market is really starting to position itself for a little bit more normalization.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This market is all over the place. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene, your market, your equity market up 32 on the S&P, advancing 0.7%.
Well, 32 S&P points up is great. At the gloom yesterday, John, we had a VIX of 32, and we come into a level of 28.17 right now. So I guess it's an improving tape, but do you trust this market?
Look at the mix of Fed calls now for next year for liftoff, Tom, for 2022. Barclays go for May, Goldman for June, Bank of America for June, Deutsche Bank for June, JP Morgan for September, Morgan Stanley go for no hike in 2022. The team at Morgan Stanley, TK, going into next year on this Fed call, looking a little bit lonely.
Well, they go into next year, and even lonelier is Priya Misra at TD Securities. You know what, John? I really don't care about the calls because everybody's guessing here, including the chairman. And to the chairman's great credit, 2 days of testimony, I think he made clear they're waiting for the data. We've got data at 8:30.
And they're responding to it as well. More data still to come at 8:30. Lisa, initial jobless claims, then it's on to payrolls tomorrow.
One of the reasons why the pivot has been so harsh over the past couple of days, we've gotten for the commentary from Jay Powell, is it's clear he's emphasizing inflation much more than he has in the past. I do wonder how important this labor market report will be tomorrow. It is a drumbeat to tomorrow, right, John? I mean, to me, I do wonder, though, is it all inflation that they're seeing and that they're fighting at this point?
That's certainly where the emphasis was yesterday, Lisa, and the day before. We've seen inflation be more persistent. We've seen the factors that are causing higher inflation to be more persistent, the words of Chairman Powell. Policy has adapted to that and will continue to adapt. That's a pretty strong signal there's more to come.
Do you think that Christine Lagarde can continue to say it's transitory, given the fact that all of her peers are abandoning her?
The pressure that they'll get from that bond market, specifically in Italy, if they try to pull what the Federal Reserve has pulled this week, I think would be very, very different to the 3% move, 4% move we've seen on U.S. equities.
But it's a credibility issue for them if they keep trying to hammer home the point of that it's going to be transitory when everybody else says, not so much.
Financial conditions, they want to keep them loose in Europe. In America, Tom, financial conditions are still very, very loose. And the big debate we've got to have going forward is not liftoff. It's how much work you need to do after liftoff to actually tighten financial conditions, given how deeply negative real rates are. are in America.
The macro's there, but the micro also. You know, Costco out with earnings, John, away from us yesterday. And I'm sorry, they're pretty good. Yeah, but Apple out with this stuff about iPhones. They're pretty good. Yeah, but. And everybody's just grasping at straws now. I mean, macro, micro, it's all the same.
Demand slowing, Tom. Would you buy an iPhone now if someone told you you've got to wait a month to get it? Is that what's going on here?
No, I would suggest that a huge body of it is a lack of confidence that you're going to go to the store, whatever, mail order, and actually get what you want. I do agree with that, John.
Your equity market this morning up 30. Let's call it up 29 on the S&P. We advanced 6 or 7 tenths of 1% on the S&P 500. It's a bounce. Will it stick? Yields are higher by 3 basis points on 10s to 143.75. 30s, Lisa, 30-year yields are near the lows of the year, and 2-year yields are near the highs of the year. Do the math, and you can guess where the yield curve is.
It's flatter, and I really am watching this because I do wonder how much this signifies a slowing economic trajectory for the United States, for the world. When does it concern market participants? When does it concern the Federal Reserve? Today, as you mentioned, at 8:30 a.m., we do get U.S. initial jobless claims. Remember that the last read was at the lowest level of new jobless claims going back to 1969. This was likely distorted. The expectation today is for 240,000, up from last week's 199,000. Still, dynamism. How much of this can sustain some of the push that we're seeing and give the Fed confidence that they can fight inflation while continuing to support the economy? Today, I'm actually really interested about this one. OPEC Plus is wrapping up 2 days of talks about whether or not to increase their supply next month. Here is the conundrum. We're dealing with this new variant of the virus. How much does it slow travel? How much are they trying to cater to President Biden? And remember, oil prices have tumbled about 20% since the end of October. Do they want to see this continue? Do they want to support this a bit while they can? And at 1:40 p.m., President Biden is expected to speak on the latest steps his administration is taking to fight COVID-19. Expect him to talk about new masking rules, talk about how we're heading into the winter months and everyone's getting together and breathing on each other and getting each other sick. This is such a tough time, John, especially as the Republicans threaten to shut down the government over some of these vaccine mandates. How do they message to people, go out there and get vaccinated at a time when so many people are sick of the pandemic and just want to move on?
What a terrible description of the holiday period. We get together and we breathe on each other and make each other sick.
How would you like to describe it? That we all hold hands and say
We enjoy each other's company and we have a great time getting together again. Tom, when did we start to describe the holiday period as a period of getting together and breathing on each other and making each other sick?
I'm old enough to actually remember when there was a wonderful majesty of this towards Christmas Eve. Yes, John, there were some excesses along the way, but
sure.
It's not about COVID. It's
about Tang.
It's slipped away over the last 10 years. Yeah, well, we got to the point where we had Tang at the Christmas party. That worked out.
Well, let's get it back, Tom. Let's get it back with Russ Kostrick now. A bit of Christmas spirit with our global allocation fund portfolio manager at BlackRock. Russ, let's start right here. Your line. We expect interest rates to rise from these low levels. We think any backup in long-term rates will be contained given a still insatiable appetite for yield. How much of what we're seeing, Russ, is that? How much of it is actually worries about the future of this economy?
Good morning, Jonathan. So look, I do think that what you're seeing now is the unexpected uncertainty over the virus. You know, we thought and we hoped this was behind us. Clearly that's not the case, and this is why you've seen this modest pullback in yields. But, you know, again, it's worth highlighting, even a few weeks back when inflation was pushing up against 30-year highs, nominal GDP was pushing up against multi-decade highs, the 10-year was at 165. That's not something that would have made sense to us 2 or 3 years ago. And I think a lot of it does come back to this longer-term secular trend that has nothing to do with the near-term inflation outlook, nothing to do with the virus over the next few months. It really is about the fact that we've been in a low-yield world for decades. You've got an aging population. People need income. And when you see these backup in yields, it's incredible how quickly people jump on that and enter the fray. And that's likely to continue even in this current environment.
Russ, I'm honored to ask you this because not only is it global allocation, but it's you really thinking across assets as well. How important is the sector call into the new year versus the individual security call?
I think the sector call is going to be very important. You know, where you are in the sector always matters, but you think about the last year. You've seen days where the market is flat, And whether you're in the right sectors or the right style has made a huge difference in your performance. So you've got to get the stock pick right, but you've also got to think about what is the regime we're in? Are we going to see inflation continue to climb? Are we going to see growth decelerate? Those are going to influence whether we continue to see technology dominate, whether we go back to that value cyclical trade. So I do think it's going to matter a great deal, particularly in an environment in which the economy, while still very strong and growing above trend, is almost certain to decelerate in 2022.
Russ, we're giving narrative to all sorts of macro themes, and it's unclear whether this narrative is actually playing out in markets. Instead, people are saying it's positioning. It's people hunkering down, cashing out of their positions after a tremendous year if they were long equity, if they were long risk. What are you doing over the next couple of weeks as we head into 2022, given the uncertainty and given the lack of conviction right now of what next year will bring?
I think the short answer is we're sticking to our positions. We've had a portfolio for most of the year, really all of the year, that has been overweight equities. We're going to continue with that because we still think an environment of well above trend growth and very low rates is still positive for equities. We're underweight duration. Again, we don't think rates melt up, but we're not changing that. And, we're also sticking to what I would call a barbell approach on the equity side. I don't think this is the time to chase deep value. I don't think this is a time to go all in on early growth. It's really a matter of having high quality cyclicals that are going to benefit from this recovery and sticking with some of the longer term themes in technology, communications, healthcare that we think are still going to work into next year.
Why do you think the dollar is going to continue to strengthen if a lot of the rate hikes have already been priced in?
The dollar, I'm going to frame it slightly differently if I can. I think the dollar has become one of the last hedges that are really working in this environment. We all know that, the correlation between stocks and bonds have shifted, has been a problem this year, given that it's traded with risk, not against risk. What's happened with the dollar is that it's actually become fairly negatively correlated with stocks. And it sounds like, fairly geeky observation, but it's important because when you get these days when the market is getting hit on rate volatility, which has happened a lot more in the last 6 to 8 months, the dollar has generally worked as a hedge. So we've been maintaining an overweight to the dollar. We're going to keep that into 2022.
Russ, fantastic to catch up and good to see you, as always. Russ Kostruck there of BlackRock. Thank you, sir. Another headline crossing the Bloomberg. We're going to get a few of these over the coming weeks. This from India. They say 2 cases of the Omicron variant detected in the country. Tom, it's hard to remain open-minded about this. You will see headlines like this. We saw one like it in the United States yesterday. I keep going back to this process, though. How transmissible is the virus? How severe is the virus? How effective are the vaccines to stand up to that virus? And Tom, the data to answer those questions isn't fully available just yet, and it's going to take a few more weeks to work it out.
I think it's going to script, and the reality is, John, you got a market position, you take the surveillance nap, and you wake up to a new world based on one not silly headline, but one genuine headline about the spread of Omicron. I'm with you, John. We got to wait and see what happens, and I can wax optimistic, but what does it matter? We just don't know within a probability distribution.
I couldn't agree more, Lisa. Inevitable it was going to be in America. Inevitable it would be in India. Inevitable it will be everywhere else as well. What we need to understand still is what we still don't know, which is to get the data to answer those 3 questions I asked just moments ago.
I love some of the descriptions out there that we all want to be hanging over the shoulder of epidemiologists that are doing the data or in labs trying to understand exactly when they release the information. We just don't know yet.
It's the problem with markets, though, right? You just itch for something to trade on. And that seemingly is what we traded on in the last 24 hours. Futures up 31 on the S&P. We've got a bounce. Will it stick? Up 0.7% on the S&P 500. Coming up a little bit later in the next hour, Subhadra Rajappa of SocGen on this rates market from New York. This is Bloomberg.
News, I'm Rishika Gupta. Apple has a problem it wasn't expecting with the iPhone 13. Bloomberg's learned the company has told suppliers that demand for its newest device has weakened. It's a signal that some consumers have decided against trying to get the hard-to-find item. Apple has already cut its iPhone 13 production goal because of a lack of parts. 5 months ago, President Biden declared the U.S. was on the verge of defeating the coronavirus. Now the virus is threatening a resurgence across the country, and the Omicron variant has been detected. Today, the president will lay out his latest plan to quell the pandemic that has dogged his time in office. It will include stricter testing for travelers from abroad and extending a mask mandate. Cleveland Fed President Loretta Mester says she's open to scaling back the central bank's asset purchases at a faster rate. Mester told Bloomberg TV that would allow the Fed to raise interest rates a couple of times next year if needed. The Fed is currently set to phase out its asset purchase program in the middle of next year. The Turkish lira is trading near a record low again after President Recep Tayyip Erdogan fired the country's finance minister. There's been an ongoing fight over monetary policy in Turkey. Erdogan wants lower interest rates to spur growth. That's led to the currency to collapse and inflation to surge. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a worldwide challenge, a natural byproduct of a world economy shut down by the pandemic as it comes back to life. Prices are still out of sync as the world comes back. This new variant is a cause for concern, but not a cause for panic. We'll fight this variant with science and speed, not chaos and confusion.
We'll hear more on the president's plan a little bit later today. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market up 27 on the S&P, advancing 0.6%. A bounce to the equity market once again. For your 10-year Treasury yield all over the place over the last week or so. Yields up again for now by 3 basis points to 143.75. Just want to sit on the words from Loretta Mester, the Cleveland Fed president, speaking to Kathleen Hayes late yesterday, Tom. Making the taper faster is definitely buying insurance and optionality. Yeah. This is the difference for me right now. There is a difference between baking in some flexibility and charting a clear, direct path towards a rate hike. And perhaps that's what separates the call coming from Morgan Stanley and the call coming from, say, Goldman Sachs. The difference between June at Goldman, May at Barclays, and Q1 of 23 at Morgan Stanley. This comes down to your forecast now, your forecast on inflation. Does inflation fade into the middle of next year? Because ultimately, that will decide whether this Fed has to make a move.
And this comes with massive credibility. Mester is a legit pro-mathematician. You know, everybody's got an angle, John, within the Fed. Very different, say, from Lyle Brainerd, both PhDs. But Mester's the real deal on mathematics. And when she says optionality, John, that carries a weight. This is about degrees of freedom where any central bank out in the future has a set of choices. For example, right now, John, the Central Bank of Turkey doesn't have much optionality.
No, because the central bank governor of Turkey is not the central bank governor of Turkey, Tom. The issue I have right now, then, when we go into December 15th, do we see the emphasis on flexibility?
Yes.
On flexibility and optionality. And is that what the chairman was trying to achieve this week, Tom?
That's what he's trying to achieve, probably with the Vice Chairman Clarida talking into his ear quietly with President Mester. Keep the options open and wait for the data to make the choice set and always lag. That's sort of the game. On to Washington right now. It is a time of year where people retire. And Jet Fitzpatrick, always studying the candidates, knows that the gentleman from Oregon and the governor of Massachusetts both grew up in Needham, Massachusetts. I mean, Jack, this is really interesting to me to see DeFazio of Oregon. He does have some health issues at 74, retire. But the stunning announcement that Charlie Baker will step aside as governor of Massachusetts. What do you read into the new retirement tone and what we'll see in the coming days?
The Charlie Baker one is a little tough to read, whereas the DeFazio news kind of fits into the trend that we've seen in which a growing number of House Democrats are retiring, especially DeFazio fits into the category we've seen. He has led the infrastructure work. He's chairman of the Transportation and Infrastructure Committee. Right. You see chairs and people who look at this as their last big chance to do something really significant, probably before Republicans end up winning the House. DeFazio, John Yarmuth, the budget chair, David Price, a lot of the mainstream longer-term House Democrats are leaving right now.
What does it say of the Republican Party? Valier's notes this morning, and this is many other people besides Greg Valliere, really talking about the disarray in the Republican Party. How does Senator Schumer, Speaker Pelosi, and other Democrats adapt to the Republican disarray?
You know, there's personal disarray, certainly, in the Republican Party. If you look at House members kind of feuding with each other. But Democrats, it's unclear if Democrats can necessarily take advantage of that because so many of their challenges pertain to their own vote count, their own struggles to keep 50 out of 50 votes in the Senate. That may sort of color the Democrats' strategy heading into the 2022 midterms, seeing if the more extreme members in the Republican Party can sort of become the face of their party. But right now, someone like Senator Schumer, Speaker Pelosi are much more concerned with sort of circling the wagons among their own members and trying to get their own votes, and campaign season will be campaign season soon enough.
I got to say, Jack, what you're describing is profoundly dysfunctional. It is Washington, D.C. Going forward, there is a question about whether we end up with some sort of government shutdown as Republicans threaten to do so in order to strip away some of the vaccine mandates that we've seen, certainly on federal workers and larger companies. Can you talk a little bit about how much Republicans are coalescing around this particular talking point?
I wouldn't say at this point that Republicans are really coalescing around this strategy, but this will be an interesting test to see how the talking point and the politics of vaccine mandates sort of act as a preview for what we could see on the campaign trail. At this point, it is looking more and more likely like that we're going to have probably a short government shutdown because of a small number of Republican senators. A larger number of Republican senators are fine with a stopgap funding measure. A smaller number, Senators Roger Marshall, Ted Cruz, Mike Lee in particular, are looking to slow things down in the Senate, and we're close enough to the Friday deadline so that they could cause at least a weekend shutdown. But really, maybe the more significant part is that this is the fight they have chosen to pick, and that this may be a very significant thing for the rest of the pandemic, this issue of vaccine mandates.
Jack, a shutdown is very different than a default. Is a default still on the table, or is that off the table, and we're just talking about more political theater when it comes to a shutdown?
Right now, the political theater is on the shutdown separately from the debt limit issue. The debt limit issue is a very significant one that is something to watch over the next couple weeks. The effective deadline that lawmakers are considering, even though it's hazy, is about December 15th. The process that Republicans are trying to force Democrats to take may be a slower process with some procedural hurdles that Democrats think could take about 2 weeks. Yesterday was the beginning of December, so really they need to start that process now and come up with a plan now. But the latest is that Democrats don't really have a plan that they have laid out. So the fact that they're not getting started now could definitely mean trouble in a couple weeks when a deadline gets closer for the debt limit.
Hey, Jack, there's some work to do before Christmas, that's for sure. It's good to catch up, sir. Jack Fitzpatrick down in D.C., our Bloomberg government reporter. Futures up 26, up 0.6%. J.P. Morgan. Marko Kolanovic over in the investment bank, Tom, making the point in the last 24 hours that Omicron could be a catalyst for steepening, not flattening the yield curve. Rotation from growth to value, sell-off in COVID and lockdown beneficiaries, and a rally in reopening themes. He keeps asking this question, and I think it's important to be open-minded about it. Until we get the data, it is possible, Tom, that it is more transmissible but less severe. And that's the kind of endgame scenario that we've been looking for the last 2 years.
Every house ebbs and flows. The J.P. Morgan Research Combine, John, right now is on fire. We're going to have Christian Malik with a co-write rather, with Marco on oil. It's a brilliant 32-page piece, and you see it across all that they're doing, including Marco saying, calm down.
Looking forward to doing that a little bit later this morning. Lisa, I believe they're at 50-50 on the S&P 500. Year-end next year.
Really. Yeah, they're looking for a number of gains. I do wonder, though, honestly, how much is due to Omicron right now, and how much is due to the fact that valuations are high, people are taking down risk, and you're dealing with inflationary threats and the idea of a potential more hawkish Fed.
Lisa, a lot of people are thinking about it. We've been talking about it for the last couple of weeks. It's important. Futures up 0.6% from New York. This is Bloomberg.
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one-directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Your stock market is higher for now. I've got no idea where this is going based on what's happened over the last few days. Futures are up 27. I'm being honest with you, at least, up 0.6% on the S&P 500. The Nasdaq bouncing back by about a third. The Russell up by more than 1 full percentage point. So we find out that Omicron is in the United States. Is that really news? That was inevitable, wasn't it? We're still trying to work out how severe this virus is, how transmissible this variant is, and whether these vaccines stand up to it. Until then, this could go one way or the other. But for the moment, we do have some calls coming through. A ton of calls on the Fed this week because of one man, Chairman Powell, and his two-day testimony on Capitol Hill. So what does it mean for this bond market? Switch on the board and get to 2s, 10s, and 30s. Here's the spread for you. Not in the bond market, but on Wall Street right now. Barclays are at May, Citi in June, Goldman in June, JP Morgan in September, and all the way out to the back end of 2023, Tom, December 23. What have we got?
I don't want to interrupt, John. I don't want to interrupt here, but you know, frankly, I think you're onto something where you say Pharaoh has no idea what's going on.
That's true. Do you want to put that in a banner?
I do.
He already did.
John,
he did. But I missed that.
But John, does Jerome Powell have any idea what's going on? And the answer is, this is really important. We're going into year-end, John. We're all blind, and I'm going to go to the great Pharaoh call of a couple years ago, where you said the year starts in March.
The year does start in March. The year will start in March, especially if they wind down QE a whole lot more quickly. Tom, that is going to become a meme now, and I'm going to blame you. That's not fair.
What's a meme?
You'll see what's about to happen on Twitter any minute now. Yields up 3 basis points on 10s. 143.58.
3, 2, 1, go.
We all have no idea. Anyone pretending they've got conviction about the future right now is doing just that, pretending. In the FX market, switch on the board, get rid of the banner, thank you. Dollar lira.
You want to get rid of jobless claims?
13.40. That comes at 8:30 Eastern. You can stick with jobless claims. Dollar lira with a move of more than 1 full percentage point. The leader in Turkey said yesterday, we know what we're doing. That wasn't a message for us. Apparently, that was a message for his finance minister. He let him go overnight, Tom. What a time to do that. 13.40, more weakness for the Turkish lira. I can't wait to get back.
I'm sorry, it's not.
Thank you for that.
It's not idiosyncratic. There's something going on here, and it deserves our attention, and we'll follow it. He's not looking at Istanbul or Ankara. He's looking at the American economy. Andrew Hollenhurst joins us right now with Citigroup. Andrew, what have you tweaked on the Excel spreadsheet in the last 24 hours? What's the mystery across the Citigroup view of the American economy?
Yeah, I think the biggest mystery that we need to address as we look at the data coming in and what the Fed needs to address is what's going on with inflation. And I think that's exactly what John was just talking about, this flexibility that the Fed has set themselves up to have now by accelerating the taper. We thought they were going to accelerate the taper. I have to say, I was surprised to hear that idea really endorsed, I would say, by Chair Powell earlier this week. So it looks like they will speed up the taper. They'll be done with tapering probably by March. That puts these earlier rate hike scenarios on the table. We're not there yet. It's going to depend on the data, exactly like John said. Nobody should be saying they have conviction on this, but the risks around inflation are to the upside. It means the risks around what the Fed is going to do are to the hawkish side.
You have the advantage of Edward Morse. We're really focused on oil today. A small bank, JP Morgan, announces that oil could pop well over $100 a barrel. How does oil fit into your Fed call?
Yeah, it's a huge advantage having Ed Morse here and his team on the commodity side have just been great on the oil call. And of course, we've had those oil prices come off, and that was what was a little bit interesting. We had a few people noting that Chair Powell pivoting more hawkish exactly at the moment when oil hits its peak and comes off. But this is about a lot more than oil. This is about more than headline inflation. Headline inflation matters. You put gas in your car, you buy food at the store, those prices matter. But we're seeing this in the core. You're seeing shelter prices rising. You're seeing core goods prices rising. Wages are increasing, and we're thinking that that is being passed through now, and we're seeing in the data that that's being passed through into services prices. So I think that's what Chair Powell is talking about when he's saying these inflationary pressures, which maybe you could have said it's specific to energy, it's specific to used cars. It just looks a lot broader now.
Andrew, we could run another banner on TV. It would say Chairman Powell has no idea what's going on. And that's basically what he told us this week. Were you surprised that he buried his baseline? Because I don't believe his baseline has changed, but he buried it and just focused on the balance of risks around this story and basically held his hands up and said, okay, my baseline's still this, but ultimately, we don't know. Is that going to be the meeting on December 15th, Andrew, looking ahead to next year? We don't know.
I think to some extent it will be. And what's interesting is we don't know, but we're seeing those risks on the inflation side. And that's what's just so different about where we are in this economic cycle relative to where we've been over the last 20, 30 years. If you have a risk of inflation, it means you want to keep options open both to have more dovish policy if you have a growth concern or more hawkish policy if you have an inflation concern. And I think we're just so used to central banks that are operating in a scenario where the flexibility is all about downside risk. Well, now we have flexibility about the possibility of getting slower growth, but also higher inflation. So I think that's why Chair Powell's opening up this option to hike earlier, accelerating purchases. That's going to be the discussion at the December FOMC, or accelerating the taper of those purchases, I should say. That's going to be the discussion in December. And then the data will tell us whether this Fed needs to be moving.
I just wonder how relevant liftoff is right now in that conversation, Andrew. Inevitably, that's the one we're having at the moment this week. You're at June, Bank of America's at June, Goldman's at June, Deutsche Bank's at June, BNP's at June, Barclays at May, JP Morgan at September. There's a big group of you now. I know you came first, but ultimately everybody's there, with the exception of Morgan Stanley and TD. Andrew, from here, I think the more important conversation is how far, how steep is the rate path from there. This is a starting point. Where are we going? What kind of rate can we tolerate? How much work do we need to do to tighten financial conditions? When you and the team sit down and have that conversation, Andrew, give us an idea of what that conversation sounds like.
Absolutely, absolutely. It's somewhat of a conundrum for us. It's certainly a conundrum for the Fed. If you look at what's happened as the market has pulled these rate hikes earlier, and the market consensus, like you're saying, has moved towards earlier rate hikes, you have short-term interest rates that are moving higher, two-year yields that are moving higher. But if you look at the 10-year yield, if you look at the 10-year real yield, it's still historically low. 10-year real yields at negative 100 basis points. Equity prices, which have come off a little bit, really on Omicron, not so much on what the Fed has been doing, still close to historical highs. So there's been no meaningful tightening of financial conditions. Now, to the discussion that we were having earlier, it's not clear that the Fed wants to tighten financial conditions yet, but they're worried about these correlated upside misses to the inflation forecast that has been the story of 2021. If that is the story in 2022, then there really is an inflation concern. You want to lean against that inflation concern, and that means tightening financial conditions, and that means expectations for where the Fed gets to in this cycle. Where is that terminal rate? Where are long-term 10-year yields? that expectation needs to change if you're going to meaningfully tighten financial conditions. I don't think the Fed is there yet. I think we're going to watch the data and see if we get there. But I do think that's the next move, these longer-term yields moving higher. Maybe not such a positive scenario for risk assets. Yeah, go ahead, Lisa. Sorry.
Well, no. Part of the confusion right now is that we don't understand what caused this sudden pivot of Jay Powell. And this was a pivot. Suddenly we went from transitory to no, it's not transitory, and we need to increase our optionality so we can raise rates sooner. Do you have a sense of what it was that triggered this change in stance?
I think it's the accumulation of data coming up against communications challenges, right? So the Fed had put in place really a lot of hurdles to moving more hawkish or moving less accommodative. If you remember, there was, a whole discussion about signaling ahead of tapering and then doing a slow taper, and then you wouldn't think about rate hikes until after the taper. And it was only a few months ago that we were not even thinking about more hawkish policy. So to work through all of that rhetoric, there was a big overhang. So the data had already moved. It was already very apparent that inflation was not transitory. That was clearly the wrong word to use to describe it. Maybe you can make some argument about looking at the second definition of transitory in the dictionary, but I don't think that's how clear communication works. So I think that had already happened. And this is Chair Powell. Basically, now they're at a situation where they can catch up with where the data are. And I think now they're in a more comfortable situation in the sense that you can respond if you need to. And that's the next question is, do you need to? But now you can respond.
Andrew, you are arguably the voice of the Los Angeles School of UCLA. This goes back to Armin Alchin and, of course, to Roger Farmer, who you wrote with as well. UCLA owns a humility over uncertainty, which goes back to Professor Alchin and his classic paper on evolution and economic theory. Color the uncertainty that we all face right now based on UCLA's academic humility.
Uncertainty going into 2022 is certainly much higher than it typically is. We were talking about the dispersion of what the Fed might do. I can see scenarios where all those calls on the Fed, May of 2022, the Fed raising rates in 2023, all of that is possible. That dispersion is just much greater. And just look at what's happened with inflation over the course of this year. If you look at the forecast error alone, multiple percentage point forecast error, that tells you that that's the kind of error band that we're operating in. So yeah, I think exactly to your point, Tom, uncertainty very, very high here, and we all need to be flexible in terms of forecasting and thinking about where things are going.
Got to stay open-minded. That's been the big challenge of the last 18 months or so. Andrew, fantastic. The consensus coming towards you, sir, in a big way this week. Andrew Hollenhorst there of Citi. Speaking about the spread in the data, we always do this going into payrolls. It's been a theme of this year. The highs